Welcome to Yahoo Finance Live. I'm Julie Hyman with Inez Ferre. Brad Smith is off today. Let's get right to the three things you need to know. First thing you need to know, Amazon's cloud business had its slowest growth ever, and that trend could continue. Amazon Web Services revenue rose 16%, and the company's CFO said April growth is even lower as customers continue to be cautious about spending. That's weighing on the shares, even as overall revenue and profit did beat Wall Street estimates. Second thing you need to know, the Fed's favorite inflation gauge showed inflation is not moderating. Core PCE, excluding food and energy, rose 0.3% in March from February. That's in line with estimates and unchanged from the prior month. The increase on a year-over-year basis, 4.6% compared with March of 2022. And that, of course, is well above the Fed's 2% inflation target. Third thing you need to know, Intel's revenue collapsed in the first quarter as a drop in PC sales hammered its business. Both PC and data center revenues fell nearly 40% due to a pullback in consumer and business spending. CEO Pat Gelsinger warned of a cautious macroeconomic outlook ahead as the company looks to regain market share from rivals like AMD and Nvidia. We should mention Intel shares are gaining, as Gelsinger also said margins should begin to widen again in the second half of the year.
And Amazon earnings out yesterday flexed a $3.2 billion profit for the first quarter, but the stock fell after a bleak outlook on cloud. Amazon CEO and CFO warned AWS growth could cool in the months ahead. Take a listen.
In AWS, what we're seeing is enterprises continuing to be cautious in their spending in this uncertain time. Customers are looking for ways to save money however they can right now.
As expected, customers continue to evaluate ways to optimize their cloud spending in response to these tough economic conditions in the first quarter. And we are seeing these optimizations continue into the second quarter, with April revenue growth rates about 500 basis points lower than what we saw in Q1. As a reminder, we're not trying to optimize for any one quarter or year. We're working to build customer relationships and a business that will outlast all of us.
And here to help break down the tech giant's strong performance is John Blackledge, TD Cowen Senior Equity Research Analyst. So, John, how significant is the commentary around cloud?
Yeah, it is, and it overshadowed what was actually a really good quarter, right? I mean, they beat 1Q results were better on revenue than consensus. Operating income was well ahead of where consensus was. And then the 2Q guide overall was also better. But then AWS, and interestingly, AWS in the first quarter with the 16% growth was actually better than what investors were looking for, which was kind of like low double-digit growth. But then, as you guys pointed out in the lead-in, the decel in April to 11% growth was, kind of low. Was kind of bigger than what people were looking for, and then you had the stock reaction, which was initially off the print up 10%. And then now it's looking down 2%. And it was all really based on that comment of the 11% growth for AWS in April.
Hey, John, it's Julie here. Now that we have gotten not just AWS, but of course the other cloud giants and gotten their numbers, is there a sense here that AWS is losing the cloud war?
Let's talk about it. So Google Cloud reported they had a 4% decel in the first quarter. AWS had a 4% decel. I think Microsoft's Azure, which I don't cover, Derek Wood covers it for us, was a little bit of a lower decel. AWS still the biggest. It is growing slower, but also off a bigger base than both Azure and Google Cloud. And I thought they were bullish on the customer pipeline being very robust. It's just more like kind of the macro is leading to kind of near term kind of optimizations in the IT budgets for their enterprise clients.
John, moving over to advertising, Andy Jassy talked about advertising trends and basically saying most people still need to shop and also highlighting machine learning. How significant do you think those comments were, especially regarding machine learning on the back of everything that we've heard about AI and machine learning?
Yeah, I thought he really, in the shareholder letter that he put out last week, and then last night on the call, he really leaned into Gen AI, and they haven't really it's been Microsoft and Alphabet in that Gen AI discussion, and obviously OpenAI, but they leaned into that. And then on the advertising side, I mean, they had 23% advertising revenue growth. Look at some of the other big platforms. I mean, Google search was up 2%. Reported, and Meta's growth, ad growth was 4%. Amazon post 23%. Obviously, much smaller base, but they're doing well. Obviously, their sellers are looking like they said. There's still consumer demand, and the ROIs are still good on Amazon from an advertising perspective. And you have this growth that is well exceeding mostly every big platform out there.
Yeah, I want to follow up on that ad business actually, because is this sort of the secret weapon that not enough people are paying attention to for Amazon? My understanding is that margins are actually comparable, or another good area of margin besides AWS. I mean, what's the potential of this business?
It's very good. They don't break out the margins, right? So they give you AWS margins, but they don't give you the advertising margins. But I don't think if the biggest part of Amazon's advertising business is sponsored products, which is basically search, right? And so we think it's similar, right, to both Alphabet and Amazon and Meta's margins. So yeah, that's one of the biggest drivers. So it's AWS and advertising are the big margin drivers for the company. And I think one of the bigger things outside of AWS revenue trajectory is kind of the rest of the biz losses coming down. What we noticed, if you look in 2022, if you back out AWS and you back out advertising, call it at a 40% margin, the rest of the biz had 26 billion in losses. Pre-pandemic, it was more like 1 to 2 billion positive. And that was a result of many things, growing the fulfillment network, doubling headcount, inflationary pressures, but that's starting to ease. And I think we saw that last night with the beat on op income in 1Q, and then the better than expected op income guide in 2Q. And part of that is based on, these efficiencies we're starting to see some efficiencies on fulfillment. And it's also helped by, like you're saying, by the advertising margin.
And speaking of efficiency and fulfillment, some of the commentary that was also talked about was progress in providing customers more one-day and same-day delivery. I mean, how significant is the build-out with fulfillment centers during the pandemic that Amazon did? How significant is it right now?
It's significant, right? They doubled their network. They basically have, they called out, they have a UPS, and they significantly expanded their last mile delivery, basically calling out that they have like UPS within Amazon now. And yeah, 26 million customers did same day delivery in the first quarter. That was up 50% year over year. The other thing that I think is important to note is that their unit growth was up 8%, but shipping cost growth was only up 2%. That was even better than the fourth quarter, where units were up 8% and shipping costs were up 4%. So these inflationary pressures are starting to ease. And by the way, the same day delivery, people just, the product conversion just ramps up if you offer faster delivery. So, we thought the retail business would be good from everything that we kind of heard during the quarter, and it was better than we thought. And in part because of the investments they made in fulfillment and transport the last couple of years.
John, as we see those efficiencies, it reminds me to talk to you about job cuts, right? We've seen, 27,000 jobs cut from Amazon, and this is something that we've really been asking across the industry. Is it done? Is there more to wring from the business over the course of the year? Right.
I think it's TBD. I think it's TBD. So if we think about the job cuts, so initially they said 10,000 last year, and then it was 18, and then after further reviews, then they cut 9,000 more. So it's a little bit unknown. You would think that it might be done, but a little bit TBD. It's the biggest cost containment review this company has ever done, and I think we're starting, like we saw with the margin beat and the better guide, we're starting to see it. But a great question, and I would think it's done, but certainly I think they'll keep reviewing, and then I think it'll depend on the macro, right? I mean, we heard from them on AWS that enterprises are optimizing because of macro, and so a little bit dependent on the macro as it relates to headcount.
And finally, something else I want to ask you about is the investments they've been making in healthcare, right? Which, if you look at the model of Whole Foods and how that's turned out, which is okay, I guess. I'm just curious, like, is healthcare going to fall into that category? How are you thinking of that in terms of their overall strategy and how fruitful it's going to be?
Yeah, it's early. I think they have a number of things going in healthcare. I think on Whole Foods, I think what they also said last night was like, listen, we want to get bigger in grocery and in store and increase the store footprint. And they said they think within the next year, they might have a concept where they can materially expand the physical footprint for grocery. And we know the reason why they want to do that is that grocery is the most frequent buying opportunity or for the consumer. But to come back to healthcare, yeah, I mean, they have a number of things going. It's early, but as it relates to the next 1 or 2 years, probably not super meaningful in terms of numbers and for investors. All
right, so we'll have to keep an eye on it in these early days. John Blackledge, good to catch up with you. TD Cowen, Senior Equity Research Analyst. Thank you. Well, we got to turn now to what's going on with inflation readings, which we got this morning. The personal consumption expenditures, or what they call PCE. As we talk about frequently, this is the Fed's preferred measure of inflation. And we're going to get you more of an explainer later on as to why the Fed likes this measure and how it's different from CPI. But let's talk about the numbers first. 0.3% was the increase that we saw in PCE on a month-over-month basis, right? That's on the core level, and that is 4.6% if you look at the year-over-year. 0.3% was also the change the prior month. That was down from about a half to 0.6%. So it is a slowdown from what we saw a couple of months ago, but on the core level, Inez, didn't budge for the second month in a row.
Yeah, that's right. And this is, as you mentioned, one of the Fed's gauges, preferred gauges for inflation. And so what it's basically saying is that inflation is still stubbornly high, and that perhaps the Fed has more to in this fight against inflation. Taking a look also at Intel. Intel posted its first quarter earnings, barely beating analyst expectations on revenue while losing less per share than expected. Its overall revenue fell nearly 40%, fueled by weak demand for most of its business divisions. Shares are rallying this morning, though, as the company posted earnings and guidance above expectations, as Intel CEO says margins should begin to widen again in the second half of the year. And later this morning, we'll be speaking with Intel CEO Pat Gelsinger all about the company's earnings and outlook. You won't want to miss that.
Let's turn now to the latest morning brief. Today, we're taking a look at a bright spot in an already better than expected earnings season. We're talking about food stocks. Investors are eating it up. Potential tailwinds like slowing input cost inflation and recovery in China could bode well for the sector. Not to mention so-called food innovations may help drive higher price points, leading to better business performances. Quite a bit of food for thought as investors for investors as corporate results continue to roll in. And we've heard a lot about the theme of pricing power over the course of the earnings season for many of these food companies as well. Here, some of the revenue breakouts, and we've also seen that some of these stocks have really performed well over the course of this week in reaction to those earnings. Well, these earnings may be better than expected. Investors, though, may want to hold off on getting too excited. Here are some of his thoughts on the food trade and what investors should be cautious of this earnings season. We have Matt Maley, Miller Tabak, Chief Market Strategist. Thanks so much for being here, Matt. It's good to catch up with you. So this has been one of the areas that's really gotten a lot of attention. And I just keep coming back to the pricing power theme, which is it's pretty surprising that these companies continue to be able to take price and that consumers keep on buying. The stocks have done well as investors have kept on buying too. Is that an area that you would be looking at?
Well, it's certainly been a great area, Julie, and I think it's going to continue to be a good one on a long-term basis. I mean, gosh, you go to a restaurant, any kind of restaurant, and they're packed all the time. But, it's interesting, too, for young people. And I don't, young people, whether it be college in their 20s, even into their early 30s. I mean, these people, they eat out all the time. And it's they don't seem to mind that some of their food that gets delivered to them isn't necessarily as hot as they'd like it to be. You know, when I was their age, if the pizzas were usually hot, everything else was cold. It bothered me. It just doesn't seem to bother them. They are eating this food all the time, and they don't really care what it costs. And it's a big market for all these food companies. The one thing I'm a little concerned about, though, is it just that they've had this huge run. On a technical basis, they're getting overbought, and on a fundamental basis, they are starting to get a little bit expensive. So if you already own them, that's fine. Hold on to them. But if you don't yet, I think you'll probably see them pull back a little bit, next month as we move into May, and that might be a better entry point for some of these names.
And Matt, something that hasn't pulled back that much is technology year to date. It's done well. We've heard from the big tech companies. You've seen the reaction on various stocks. What do you make of what's been reported so far?
Well, it's been, a big surprise, but it's certainly been a pleasant surprise in that a lot of people were looking for these tech, especially the big cap tech names, to report disappointing earnings or at least give disappointing guidance. The one thing, again, they've had a great run here. The one thing I'm a little worried about, though, is that we've had this huge. I mean, if you look at 24% of the NDX, the Nasdaq 100 index, which is heavily weighted with tech stocks, 24% of it is Google, Microsoft, and Meta, which have all reported unbelievable earnings this week. Two of those stocks have rallied in a major way, and yet the index is only up 1%, and the S&P is actually flat. And if you look at the XLK Tech ETF, this month it seems like done really well, but it's actually down on the month slightly, only about 1%. And you also have the semiconductor stocks have had a tough month. They're down 7%. So it just seems to me like even though the headlines are and the individual moves and some individual names have been really good, it does look like this narrow rally in the tech stocks is starting to level off a little bit.
And so what then, Matt? Like, what does that tell you, I guess, about the sustainability of this move and where investors should be looking?
Yeah, I think it makes it hard for it to be sustained. I mean, the semiconductor group, the SMH technology ETF, I mean, that is one of the best leading indicators for the stock, not just for the technology sector, but for the entire stock market. And that's been the case for several decades. I mean, I remember back in 2018 when the chip stocks rolled over in May, and several months later, the whole market rolled over along with it. We're kind of seeing that decline now, again, down over 7% so far in April. If they continue to head lower as we move into May, that's going to tell us that such a narrow rally in the tech sector is going to fade. And if that fades, the rest of the market is going to fade with it.
So are we headed towards a hard landing, do you think? And if so, what does that look like?
Well, I do think we are headed for a hard landing. And we've heard about in the tech area and several other areas, food stocks and others, where the earnings have been quite good. But some of the really important economically sensitive areas, we've had some very disappointing numbers. I mean, look at UPS, and all of them cited poor demand, slowing demand. UPS. Old Dominion Shipping, one of the big trucking companies, and the transportation index has been hit because of that this week. Cat Tractor is down, and of course the semiconductor stocks, which are very economically sensitive. So a lot of these areas aren't doing as well. These economically sensitive areas aren't doing as well. And then when you have we throw into that this whole situation with the bank stocks and the credit contraction that's going to go with these failures. That just tells me that we're not going to have a soft landing. I used to say it'd be very difficult to achieve a soft landing. I think now it's going to be even a mild recession is going to be hard to come by. I think it's going to be a more a severe one, but a more normal recession that we have seen in the past.
Matt, you mentioned freight volumes. What's interesting is that as far as the consumer is concerned, Amazon in their call talked about the consumer going towards lower price items. Overstock had similar commentary as well. Yet you still have Visa and MasterCard that is saying that there's still spending going on. So how do you decipher that?
Yeah, it's one of the things, and I was just looking at this yesterday because, as you mentioned, Visa earlier this week and MasterCard, I think it was yesterday, and American Express was about a week and a half ago or so. These companies, reported some good things, but their stocks haven't done anything. Visa initially opened higher, but has actually traded off since then. MasterCard, I mean, everybody was talking about how great their numbers were and how great the consumer is, and yet the stock traded off a little bit. We're also seeing the retail stocks, the XRT retail ETF. That's badly underperformed the stock market so far this year. So even though we're hearing all this stuff, positive news about the consumer, we are hearing these anecdotal issues that they are starting to move down a little bit. And the forward-looking, the stock market is a forward-looking enterprise. When you see these stocks like Visa, MasterCard, and the retail stocks trading lower, it tells me that they're seeing that maybe that demand isn't going to remain so strong in the 3 to 6 months into the future.
So Matt, where do you go? It sounds like you're pretty negative on equity. I mean, do you go into fixed income? Like, what do you do right now?
Well, I do think raising some cash, a little bit more cash. Again, you're getting paid to wait now. Money market funds or even just T-bills. If you run, you can buy them directly from the government. No commission or everything. 3 or even 6 months out. And just roll those. I mean, you're getting 4, 5, 6% depending on what you can get. So that's not bad. It pays you to wait, I guess is my point. But there are other areas. I mean, I tend to be more in the defensive area. But it's funny, we talk about one defensive group. It's the defense sector. And, these stocks have been acting very well lately. And I guess my point is the world is not becoming a safer place. They're starting to tone down a little bit on the top with China just this week, but we have obviously Ukraine and Russia. We have the issues with Israel and Iran, et cetera. I don't think military spending is going to go down anytime soon. So that's an area where we can hide. And I still think the energy sector is one that even though oil prices are down back below $80, they'd have to drop below 60 for these companies not to be profitable. So I think there's still some good plays where you can still make some good money.
All right. Hope is not all lost. Matt Milley, Miller Tabak, Chief Market Strategist. Good to talk to you as always.
Thanks, Julie.
Coming up, Snap and Pinterest earnings painting a different picture from the big tech results we got earlier in the week. We're going to break down another batch of earnings for you on the other side, and we'll have the opening bell. Let's take a look at some of today's market movers, starting on the social media scene. Snap and Pinterest taking a dive following the latest quarter. Snap reporting a miss on revenue as it struggles amid a steep decline in advertiser spending. This as Pinterest provides a disappointing outlook for the second quarter. And we're going to talk more about this with an analyst in just a bit, but it is an interesting disconnect, Inez, that we have Amazon on the one hand, Alphabet as well, you know, some of the other bigger tech companies, Meta, saying that advertising's doing okay. And it doesn't seem to be the case for Snap in particular.
Yeah, that's right, especially because Snap had also invested in its advertising, the way it also shows advertising. So that's not expected to sort of come out in results and more positive results until later on. So that's part of why you saw the disappointment here. But as far as Pinterest is concerned, what was interesting was their monthly active users. That was up 7%. And something that I found interesting from their earnings call as well, Gen Z users are finding value in engaging with the full breadth of content, including video. So video also going to start taking a more prominent role when it comes to the discovery platform.
Yeah, I mean, I think both of these companies are, but more so Snap, as you said, is trying to do that ad transition.
Yeah.
And then when you layer the macro on top of that, that seems to be what's causing these particular challenges, right? Is that the backdrop is not great right now for it. So that really was in focus for Snap, I think, in terms of what analysts were talking about. Morgan Stanley, for example, saying the company's early in its migration to build that more of a performance advertising business, and that creates high execution risk.
Yeah, and this is something, the macro picture is something that Snap had been talking about since last year, a deteriorating basically macro backdrop. Their average revenue per user, that fell to $2.58 from $3.20 year over year. And so that's very significant because that's one of the metrics, ARPU, that analysts take great note in. So that falling also weighing on the stock as well.
Yeah, we're gonna keep talking about this with Rohit Kulkarni in just a moment to try to get to the bottom of what's going on with these two companies in the bigger ad picture. We got to talk about big oil as well this morning. Chevron and Exxon both out with a beat. However, Chevron reporting production slipping as Exxon staying on track to repurchase up to $17.5 billion of shares during the year. Not seeing a lot of change in those Exxon shares. Chevron shares are a little bit lower. By the way, the Exxon first quarter profit is the highest start to a year that it has ever had. That profit at $11.4 billion, and it's now been 4 straight quarters that its profit has been above $10 billion. So it is definitely continued to wring more out of the oil picture here. Also, a couple other things to talk about here is that production is indeed going up for Exxon in many areas. Off the coast of Guyana is where it has some operations, and the U.S. Permian Basin, seeing that production there was up 40%, according to an interview that the CFO gave with Bloomberg.
And I think what analysts are really trying to figure out is what will Exxon do with all the cash that it's sitting on. And there had been a report in the Wall Street Journal not that long ago talking about Exxon eyeing Pioneer and the acquisition of Pioneer, and the CFO of Exxon saying that Exxon will be very picky over any acquisitions. But what will they acquire? Which company would they acquire? Would they be willing to foot a bill for Pioneer? $50 billion, what it seems like, or some of the estimates out there.
Notably, they did not increase that buyback authorization of $17.5 billion. So that's not one of the ways that they're going to be spending the cash, or more cash, at least not for now. But yes, that is a big outstanding question for investors. And then when we talk about Chevron here, the company's earnings did beat estimates as well. Their net income was $6.7 billion, and its refineries made $1.8 billion during the quarter, which was also better than estimated. Production in its Permian operations are going to grow about 10% this year, but those shares are not going up this morning.
Yeah, it's refining earnings, which surprised the street, and especially internationally as well. Refinery being one of the refining capacity we know that has been very tight in the U.S., and calls for more refining capacity in the U.S. as well. Yeah. Here's the opening bell on Wall Street.
Yeah, we got the opening bell on this Friday. As we just heard Matt Maley saying a little bit ago, it has been a week that's been characterized by mostly better than estimated tech earnings, although Amazon is certainly an exception to that today. We've had a lot of food companies come out with positive earnings as well. And yet again, overall, we have not seen that big of an increase in the Nasdaq 100, which is quite heavily weighted towards large cap technology. So something to keep in mind here as we look at the weekly performance. I thought yesterday was Take Your Child to Work Day. I guess there's kids down at the New York Stock Exchange today as well, getting excited about the start of trading. Investors not very excited though. We've got a lower open here this morning, modestly so. The Dow, the S&P, the Nasdaq all trending to the downside, but none more than 0.2% here today. We have all the earnings to contend with. Investors looking at that. We had PCE coming in line with estimates, showing that inflation is still sticking around. It's not going anywhere. And so all of that considered, stocks a little bit to the downside, you know.
Yeah, that's right. Stocks to the downside. We're looking at all three major averages that are down about 0.2%. If I'm going to pull up a 5-day chart here so you can see where we are set to end the week. Nasdaq Composite is basically flat right now, where we're set to end the week if we were to continue on this pace. Looking at where we're at with the sectors, we are seeing a little bit of a muted action here. Well, let's take a look at the Nasdaq 100 since I just mentioned it. We're seeing the mega caps that are a mixed picture right now. Amazon down more than 1%. Remember, Amazon, after it reported its results yesterday and after hours, the stock shot up and then came back down on that cloud warning. Intel up more than 5% after reporting its quarterly results. Taking a look over at the sectors, as I mentioned, you're looking at consumer staples, industrials, utilities, hanging on to some green there. But we're watching financials, which we have been watching throughout the week, and also communication as well as energy, which are lower as well. And over on the regional bank sector, because we had been watching throughout the week what had been going on also with the regional banks, Julie, just a little bit of pressure with these banks. FRC more than 2% right now.
Yep, thank you. And then let's talk about Cloudflare as well for just a moment, because really echoing some comments, it feels like, from what we heard from Amazon in terms of cautious spending on the part of customers. Cloudflare sinking into the red deeply, down 25%. Its revenue forecast coming in below analyst expectations. Again, increasing macroeconomic uncertainty is something that's been banging the drum on as well. And Peter Bookvar, who's a strategist I follow, kind of flagging some of the commentary from the call in his morning note, because in the call, we heard the CEO saying this quarter reminded me of the first quarter of 2020. Businesses were paralyzingly nervous about the impact of COVID-19. Now there's uncertainty in the economy that is causing a lot of uncertainty. He called out the delays, not necessarily cancellation of contracts, but Matthew Prince, the CEO, calling out the delay in contracts, and that is proving problematic there for Cloudflare. This might be a record drop that we're looking at, that 26% drop in those Cloudflare shares as we get underway here this morning. And this is really a surprise to investors. Cloudflare had been holding up a little bit better. Cybersecurity more broadly had been holding up a little bit better than, say, cloud or some of the other areas of the enterprise software market. And so it's interesting and surprising to see this kind of action here. Just to give a little more color and details around the forecast, the company saying for the second quarter it will have at most $306 million in revenue. Analysts have been predicting nearly $320 million in revenue. And similarly, we are seeing for the full year, it looks like that revenue is going to be short of estimates, although it looks like the profit forecasts are better than had been estimated, but that is not mitigating the drop that we are seeing in those shares here this morning. I'm just checking on short interest. When I see a drop like this, I'm always curious. It looks like it's about 7.5% of float here. So not huge, but not nothing either. So we'll keep watching those Cloudflare shares. Coming up on the menu of inflation measures, the Fed's got a clear favorite. It isn't CPI. We've got the latest PCE data. We had that out this morning. And what is it, though? We're going to explain on the other side.
The Fed's favorite inflation gauge showed inflation is not moderating. Core PCE, excluding food and energy, rose 0.3% in March from February, in line with estimates and unchanged from the prior month. But what does it actually mean, and why does it matter? Yahoo Finance's Josh Schaefer is here to explain. Josh.
The Personal Consumption Expenditures Index, also known as PCE, is the Fed's preferred method for measuring inflation. But what does PCE actually mean? It's an index measured by the Bureau of Economic Analysis, also known as the BEA. It tracks the consumer side of prices for goods and services by measuring changes in the cost of living for households. It follows the prices of a basket of goods and services, and each item in this basket carries a different weight. For example, if the price of gas rises, that has a bigger impact on PCE than the price of tomatoes because it represents a larger portion of consumer spending. This basket of items changes every month, all based on consumer trends, unlike CPI, which changes every 2 years. The data comes from surveys of businesses rather than what consumers say they're spending on goods and services. In the PCE index, the BEA separates consumer goods and consumer services into 3 categories. There's durable goods, items that last 3 years or longer, like cars and trucks. Non-durable goods, items that last less than 3 years. And then there's services, things like housing, healthcare, and transportation. But why does it all matter? It's all about the Fed. Both PCE and CPI help policymakers understand the health of the economy. The Fed prefers PCE because it changes its basket more often, which provides a more accurate reading of consumer trends. When the data continues to come in high, the Fed interprets that there is upward pricing pressure in the economy, which often impacts their policy decisions.
Yeah, it all comes back to the policy decisions of the Fed when we're talking about PCE here. And there's nothing really in this report today that gives them cover to pause in their meeting. They're meeting next week, May 3rd, right?
Right.
And there's not meaningful slowing in PCE.
We've been talking a lot about the fact that inflation has been a lot of different words out there, but basically it won't go away, right? It keeps staying up there, and it keeps staying. And when you look at that graph that we've showed with that PCE graph, specifically the core PCE graph, it's really almost gone flat in some ways, and that is not what the Fed is looking for. We know they want to get that eventually down to 2%. Right now, we're not really even close to that 2% mark, guys. So it's certainly something we're going to keep talking about. We'll probably keep explaining it over the next couple months, and it's definitely not going to be going anywhere.
Yeah, definitely not. I'm looking, you guys, at a note from Krishna Guha over at Evercore ISI, who is a avid Fed watcher, and he's in the camp, as are most of, I think it's safe to say, investors at this point, that the Fed is going to raise a quarter point next week and then sort of leave itself room to pause with an eye on what it will do next, leave itself the door open to potentially raise even more, depending. He talks about First Republic as a little bit of a wild card here. I mean, I know most of the folks we're talking to say the most acute phase, in the words of one analyst we spoke with this week, of the banking crisis is over. But
there's still the overhang of what will happen exactly with First Republic.
Right, and what's going to happen more broadly with loan growth in the economy as well.
Yeah, exactly.
All right, well, coming up next, as tech companies of all sizes continue to grapple with disruptions in the ad market, some businesses are adjusting better than others. We're going to talk about what they are, who's doing well, who's not. The arrival of big tech results this week, giving investors a boost earlier with the likes of Meta and Alphabet beating the street. Ad revenue surprising on the upside for the company formerly known as Facebook. While it slipped for Google's parent company, it did still beat expectations. Amazon solidifying that narrative with growth in the space yesterday, outpacing even its powerhouse cloud services unit. The big picture takeaway seems to be that resilient digital ad spending, that's happening, but only for the largest tech platforms. It's a different story for Snap and Pinterest. Shares in the former nosediving on a revenue miss, but the big issue was comments on continued disruption and demand in the ad space. Pinterest followed that theme with shares slumping on weak ad spending. Joining us now to make sense of it all is Rohit Kulkarni, Roth MKM Managing Director. Rohit, are we reading this correctly? Do we see a sort of large and medium divide here when it comes to ad spending?
Hey, I think you're hitting the nail on the head here. I think the way we feel advertisers start thinking about.
I think we have a problem with Rohit Shah. Rohit, do we have you?
Hey, I'm back here. I can see you.
Okay, we'll give it another shot. Try again.
Okay, yeah, take two. So I think when ad budgets stop growing, advertisers try to gravitate towards tried and tested large platforms, Google, Facebook, those are the ones. And smaller companies tend to have more experimental budgets that disappear. So in recessionary environments, in slow growth environments, we see market share of companies like Google and Facebook grow, and Snap and Pinterest probably are going to face more headwinds than what larger companies are facing right now. So that's the issue. And on top of that, there is mix in customers, mix in brand and direct response. So I feel Snap and Pinterest are going to be in this penalty box until the pie starts to grow. And perhaps it's not going to be until late this year, early next year.
Rohit, Evan Spiegel, the CEO of Snap, talked in the earnings call about Q1 being disrupted with changes that the company made to the ad platform. How do you see that developing going forward?
Snap is probably anywhere between 6 to 12 months behind, say, Facebook when it comes to adjusting to all the changes that happened to mobile advertising made by Apple. So Snap is adjusting to all those changes. They're trying to re-architect their ad tech. They're trying to do more direct response, bottom of funnel advertising. And essentially they're trying to redo various different policies and processes and as well as technology that advertisers see. And it's a learning process. It is probably going to take a lot of experimentation for Snap, and those experiments would lead to some disruptions. What we heard on the 1Q call was just one of those experiments and one of those disruptions. I foresee more of these to come, but I think that's what a company needs to do. They need to continue accelerating these experiments and continue to learn from them, and perhaps come on the other side much stronger and much more kind of battle tested, if you will. Snap is probably in second or third inning of that series of experiments. Facebook went through all of that in early 22, and now late 22, early 23, they're seeing rebound. Larger companies have more ways to experiment, and I think faster turnaround as such.
I mean, also, I guess you could argue then that Facebook was doing it in a more healthy economic environment, right? A less slowing economic environment. So that creates an additional challenge for Snap layered on top of this. And then we haven't even talked about TikTok yet, right? And the competition that they are seeing. How are you thinking about TikTok right now, and what effect will a potential ban on TikTok? We're already seeing partial bans or sort of around the country. What effect is that having, and could that have?
So TikTok has kind of firmly positioned itself right after Facebook, Google, and clearly above rest of the players in the industry. So I think when it comes to advertisers and when it comes to allocation or waterfall of how they think about ad budgets, TikTok has become a very solid number 3 player when it comes to this flavor of social media brand advertising, if you will. if TikTok were to be banned, I think from a sentiment standpoint, I think Snap is the one that stands to gain the most. From a fundamental standpoint, I think the dollars would be spread around more towards Instagram and then towards Snap. Needle mover change for Snap, less so for Instagram, given the scale that they already have. But I think from a near-term perspective, we don't. Our base case scenario is TikTok continues to operate. Perhaps they agree to some concessions. So in the next 3 to 6 months, while advertising is going to be soft, Snap continues to see the headwinds, both from TikTok from a competitive standpoint, also from macro headwinds that ad spend is going to remain soft.
And you have a neutral rating on Snap. You have a neutral rating on Pinterest. Regarding Pinterest and what we saw from what Pinterest reported, what would make you change that neutral rating? What stood out to you in their earnings call?
I think if you would have heard the earnings call in isolation on Pinterest and heard the extremely positive tone from the CEO, one would have thought that Pinterest just had a fantastic blowout quarter. The tone from management is quite positive. They are bringing in new executives. It's fairly common when you have a new CEO, he brings in new C-level execs into there. So Pinterest in the first 1 year of the new CEO is bringing in new execs. So then the year after that, the entire team starts running together as a well-oiled machine. So we are on that cusp of that. So we like that. And secondly, they're doing these partnerships, the Amazon partnership that they announced. They're doing more shopping on Pinterest. So all these are good innovations, and I think bode well for Pinterest in the next 12 months. So good management team, good partnerships, shopping on Pinterest, those things should, in theory, start to help Pinterest fundamentals. Right now, the fundamentals and the tone are two separate stories, and I think at some point, both of them start to intersect, and probably that happens in 3 to 6 months. We need to see just essentially more traction in advertising via shopping partners, and probably they're showing the right seeds. Just need 3 to 6 months or more.
Some great insight on Snap and Pinterest. Rohit Kulkarni, Roth MKM Managing Director. Thanks so much for joining us.
Thank you.
And coming up, Julie has her eye on a couple of trending tickers. She'll break down everything you need to know on this Friday.
As promised, I have some trending tickers for you. All of this coming to you from the Yahoo Finance platform. And what tickers you guys are looking at the most are Yahoo Finance users. So Amazon shares are down about 4% in today's session. Just to make our chart look a little better, let's look at the 5-day look as well, down about 1.4% over that time. And remember, we have talked about the cloud disappointment, the slowest growth for the cloud unit ever, AWS, at Amazon, and talking about continued slowing happening thus far in the month of April. That's really what's weighing on ExxonMobil. We talked about as well. Those shares are actually now in the green a little bit more. They're up by about 1.7% after the company posted its best first quarter ever as well. And that company is a lot older than Amazon, is 140 years old with those numbers. One of the other things that's been interesting over the past couple of days as well, we've seen cropping up some of these small Hong Kong-based stocks that are sort of meme that have been coming up in the trending ticker column here. Top Financial Group is one of those. It's an online brokerage that's based in Hong Kong. The shares are 175% today, no big deal. But if you look at the 5-day chart as well, you see that 780% increase, give or take. It's again one of these sort of meme type situations. Magic Empire is another one. MEG is the ticker on that one that falls into that category. It also is seeing similar action over the past week. Don't know what's fueling this, but just something that caught my attention because this kind of thing happens now and again. Also catching my attention, of course, is Intel. Even after reporting disappointing numbers, the company raising some hopes that the second half of the year will be better. We're going to hear from Pat Gelsinger directly in the next hour on that front. And then just catching one other one here on the earnings front. First Solar, which is down 20% this week and down 13% today after the solar panel manufacturer reported its numbers. So a lot of earnings news here on the trending ticker page today. And coming up, a big part of the earnings picture as well has been AI, the next big shiny thing when it comes to tech companies. Amazon, Google, Microsoft, Meta, all mentioning that buzzword nearly 50 times on their earnings calls. But is it the real deal or another fad or both somehow? We're going to tell you next. Welcome back. This is Yahoo Finance Live. I'm Julie Hyman with Inez Ferre. We've got consumer sentiment coming out from the University of Michigan right now for the month of April. 63.5 is the reading. That's bang in line with estimates here. I believe this is the final read, if I'm not mistaken. 68.2 current conditions and 60.5 for expectations. 1-year inflation expectations at 4.6%, which coincidentally or not, is right where we saw PCE at the core level today, year over year for the month of March. So it looks like consumers have their finger on the pulse, actually, of what's going on with inflation right now. But it's interesting that they expect that to be the inflation a year from now as well.
And some of the commentary that we are seeing from the report, consumers still perceive relative strength in labor markets and incomes, but signs of weakening labor market expectations have emerged. Also, the report talking about uncertainty over short-run inflation expectations, which rose this month. Thus, volatility and expected year-ahead inflation is likely to continue. It's worth noting that, so we're getting this read. We got the PCE read earlier, which is a gauge that the Fed takes a look at when it comes to inflation. And there still seems to be a little bit of room for just a little more tightening, perhaps.
Yes, it seems that way. That seems to be what the consensus is for the meeting next week. What's really interesting to me, too, is that it continues to be, and as we keep hearing from all these companies, people are paying the higher prices. They're not seeing a lot of pushback, a little bit of trade down at the margins. Maybe they're not buying as much stuff, but they are still paying the higher prices. But they don't like it, right?
Yeah.
We're paying the higher prices, but they don't like it. And this is, I think, reflected in this report. Again, the commentary from the director, Joanne Shu, who at the University of Michigan, saying the improvements that we saw here were balanced by worsening assessments of personal finances due to higher expenses, reflecting the ongoing pain stemming from continued high prices.
Yes, and the consumer is feeling like, look, when it comes to food, and we saw this from the food companies as well, they've raised the prices, and people are still paying for it. Perhaps not as much volume, but they're still paying those prices. But when it comes to certain goods, you still need what you need. And that's true. We saw that with Kimberly-Clarkson as well, with the essential items that they offer as well in their commentary. Even Amazon talked about that people still need to shop for the products that they need. Right. As you mentioned, they don't like it.
Right, they don't like it. And there is some stuff that's moderating, right? One story that caught our eye this morning from CNBC, they cited a market research firm called Urner Barry saying wholesale egg prices could fall to as low as $1. That's not what we're paying, but that's the wholesale, on the wholesale level. So, I mean, I guess at least we're getting relief on eggs.
Yeah, and Brian Sage is going to be really
excited about that, I'm sure.
Turning now to this week's top story, AI dominates tech earnings. In those calls from Alphabet, Microsoft, Amazon, and Meta, the recurring theme was artificial intelligence, each company laying out its case to investors for why they, and they alone, are the vanguards of AI. Take a listen.
These large language models and generative AI capabilities, they've been around for a while, but frankly, the models were not that compelling before about 6-9 months ago, and they have gotten so much bigger and so much better much more quickly.
In search, we've been using AI for a while. It's what has really helped lead search and search quality for the past few years.
We will continue to invest in our cloud infrastructure, particularly AI-related spend, as we scale with the growing demand driven by customer transformation. And we expect the resulting revenue to grow over time.
As hiring resumes, you'll find the biggest areas that we are hiring in will be to support priority areas like generative AI.
And the corporate dollars might be heading to AI, but let's look at what investors in the space think. Joining us now is Brett Winton, Chief Futurist at ARK Investment Management, and Sachin Dev Dugal, founder of Builder.ai. Brett, let's start with you. We continue to hear quite a bit about AI as it relates to cloud, as it relates to advertising with some of these big tech companies. Which are the areas in which you see the most potential and growth going forward with AI?
Well, it's clear that there's going to be, we believe, trillions of dollars that will be spent on AI software over the course of this business cycle. And it's interesting to me that everybody seems to think that mega cap tech is the place to play. That might be the most dangerous place to be, given how they were all in their own competitive swim lanes, and now they're all competing with each other in this emerging technology area. So we actually think some of the interesting places to invest are companies that have deployed in-use assets and can deliver AI software to those assets. So take Tesla, has the largest deployed fleet of robots in the world. If you can turn those cars they sold into robo-taxis, then that transforms their economic model. Given the pace of advance in AI, Tesla is better positioned to take economic advantage of it than some of the underlying AI-focused tech companies that are beginning to compete with each other in a really aggressive way.
I would argue that's still a big if that Tesla has not proven out, at least not yet, Brett. But I want to come back to that in a minute because I want to bring Sachin into this discussion because his company does AI. Now, you can't invest in it yet, at least not in the public markets. It's a privately held company. But Sachin, I'm curious, there is such this clamoring about AI. What are you hearing from customers and potential customers? Is this something that they are getting really excited about here? And just for people who aren't familiar, give us like the 20-second description of what you guys do.
Sure. No, thank you so much again for having me. I think the most important thing I'm hearing is a little bit of hysteria meets a little bit of confusion, if I'm honest. So our platform allows people to build software. We use AI in combination with human efforts. So think of it like Lego-like reusable features to allow people to build any kind of software application. And what we're hearing from customers is an element of excitement because it's something new and everybody's talking about it. But it's coming with an equal dose of confusion in terms of how they might use it. Is it really new? Will they have to change sort of their labor hiring and labor patterns? And it overall just seems very misunderstood, especially given we are probably in the AOL of the AI world right now, whereas the perception with some folks is that we're in the fiber optic world of AOL, of broadband.
Brett, a lot of companies are talking about the fact that this is an inflection point, or we've heard some commentaries about that we're in an inflection point right now. Are we? I mean, what is it that suddenly in the last 6 to 9 months, everything accelerated and we are now seeing the great benefits of AI?
Yeah, I mean, I think it always looks like an inflection point when you're in the moment. But I think if you fast forward 3 years, this will seem like a relatively flat place, and that will seem like an inflection point. The cost to train AI systems are falling 3x per year in our view. So, if you are 6 months behind in AI, that's the equivalent of being 2 years behind in computers and traditional technology cost decline. So,
but I mean, if the opportunity, though, Brett, is as big as you say, it doesn't feel zero sum, does it? In other words, like even if let's just take, I mean, it's not apples to apples, which you'll see why that's not the best pun. Like the Apple model, in other words, like it comes late, but it does it better. Like is AI not going to be like that? Do you have to be first here?
You don't have to be first, and there is, I agree, clearly a tremendously large opportunity ahead of these companies, but it is, in our view, a platform transition. And usually in platform transitions, incumbents stumble. And so look at Google search, that is a franchise that is a massive monopoly. It's worth, 100 plus, it's 160 billion in revenue per year. And that profitability is being put under threat by AI. So the fact that the opportunity is so large means these companies that right now are very large actually might be small relative to the ultimate opportunity. That both means, hey, if they can get in front of this, they can grow quite a bit larger, or it means somebody else could eat them up along the way.
Sachin, how do you see spending as far as your clients are concerned going forward? I mean, are they putting this as a priority when it comes to spending in AI? And what do you see going forward if there is a slowdown?
I think the widest spectrum is we're seeing more people build software at an unprecedented pace. Today, the worldwide demand for developers is probably over 500 million, and the worldwide supply is probably shy of 50 million. And I think this is driven largely by every echelon of the business sort of pyramid, right? From small businesses or micro SMBs, up to enterprises, the edge of enterprise. There's almost 100 million new companies being started every year. And so you're definitely not seeing a slowdown. I think what you're seeing now, and especially what happened with AI, is the user interface has changed. You've gone from a world where we used to give people tools and people struggle to use them. Most people use a calculator with Excel, for example. And if I said Java, they think coffee, not a programming language. And I think what you're seeing with what's happening now is the user interface has gone back to something that they feel a lot more comfortable, which is conversation or speech or that chat-like experience, but it's much richer. So you're seeing a lot more demand. The interfaces are becoming easier, especially with sort of platforms like ours. And we're taking away the technical expertise that you needed to be in the digital game, and which means now that small businesses will start using more and more AI, more and more recommendation systems, which, by the way, are not new technologies. They've been around for a while, but they've just become more mainstream.
Yeah, and I guess the ease of use, to your point, might be experiencing a change. Sachin, one more for you, because your comment caught my attention a few moments ago when you talked about the hysteria and confusion around AI. What would be like the big picture message that you would want to put out on that front to try to clear up the hysteria and confusion?
Yeah, I think it's a very powerful technology, but it's not new. And the ramifications of it are still not understood, partly because it hasn't really reached prime time. And so when you think about where AI is today, it's almost like a young child, and so needs to be sort of looked at and evaluated as a young child that can do some really incredible things, but it's still a young child. It hasn't built a value system as such. And when I think about how people are concerned like the jobs are going to disappear tomorrow, I think what you're going to first see before really jobs disappear en masse is you're going to see people become more efficient or more efficient, because there is generally across industries a massive mismatch between demand, which is growing rapidly, and supply and the rate at which we can produce skilled labor. And I think just the AI itself is very nuanced. Everything is not a large language model. Everything is not going to sort of be in front of you tomorrow. And so for the creative elements of society, it's great because it gets rid of some of the mundane work. And then for business processes is also really solid because it's allowing businesses to operate with lower costs, which I think is really key for where the world is right now.
And Brett, finally, want to turn the last one to you. Given, I'm sort of torn here because on the one hand, I'm getting the message that it's early yet, and we don't know quite yet how this is going to play out. On the flip side, you're saying like there are companies that already have an advantage here and going to push ahead. Brett, for an investor, what do I do between those various messages?
Well, I think it can both be early and large, as in if the ultimate opportunity is very large, and companies are already seeing ROI on deploying AI against their processes today, it means that you will see a lot of companies pull ahead of the competition because they're more agile, they're more innovative, they have distributed assets that they can push AI software into, and kind of the ultimate opportunity for those companies could be transformative. So we believe that the entire business landscape is turning over under people's feet, and it's not a small turnover. It's a big, monumental, historical turnover comparable to the innovation cycle 100 years ago with electrification and the internal combustion engine and the telephone all entering the marketplace at the same time. That's really the scope of what's occurring here. And it means that every technology is going to accelerate. It's not just AI. Every company is going to have to become a technology company to compete and survive. And every person is going to effectively become a coder using an AI system. Every knowledge worker will, at least. And so we believe that this will both transform the economy and that we are in the earlier stages. Both of those things can be true simultaneously.
Yeah, no big deal. No, just kidding. Brett Winton drawing a rather grand picture there. Brett Winton, Chief Futurist at ARK Investment Management, and Sachin Dev Dogal, founder of Builder.ai. Thanks to you both. Really appreciate your perspectives. Turning now to our trending ticker, it's Colgate-Palmolive squeezing out past its competitors. The consumer packaged good company seeing earnings rise on a steep increase in prices. That's what we've been hearing all week, hasn't it, from food companies and the likes of Procter & Gamble, who reported a similar pricing strength during the quarter. Among the flurry of analyst reactions, Barclays taking note of Colgate's better than expected organic sales driven by volume and price and volume, which is not something we've seen for every company here. Well, coming up next, we're going to be refocusing on oil in here. Chevron and Exxon both beating expectations in the latest quarter. But will this continue as travelers prepare for summer road trips and the supply-demand oil dynamic changes? We've got you covered next.
Brian Zazi of Yahoo Finance here, and we're getting ready to descend at the 26th annual Milken Conference in California. Here are three things I'm watching at this conference. So many things, actually, that I'm holding my computer because I can't keep track of all the stuff. First up, this will be the first time we'll get to hear from top leaders like Citigroup CEO Jane Fraser on the impact or the aftermath of the March banking turmoil. Excited to hear that. Number two, big ideas. The Milken Conference is always a great time to hear the biggest of the biggest ideas from top CEOs and top names in global business. And last but not least, this is a key conference to get the insight into the global economy. A lot of leaders from around the world will be at this conference talking about demand in Europe, talking about demand in China. Lots going on at the 26th annual Milken Conference. Yahoo Finance will be there all week. Giant interviews. Tune in.
Despite concerns from investors that a sluggish economy would lead to a decrease in energy demand and subsequently reduce profits for oil companies, that's not what's happening. ExxonMobil and Chevron both demonstrating resilience in the first quarter by posting healthy profits despite the drop in gas prices. Wells Fargo analyst Roger Reed is joining us now to discuss both of them seeing some interesting production trends, particularly what we're hearing from Exxon. Exxon also has a lot of cash on hand. Roger, first of all, just sort of give us your big picture takeaways from these two, and if there's something, a sort of theme that you're reading as we're starting to get big oil.
Yeah, thanks, Julie, for having me on here. Yeah, I think if you look at the quarterly results, I mean, what you see is these companies have reduced their costs a tremendous amount. And so, yes, prices are good, but business has actually been improved, right? From how they capture at the wellhead, the costs they've taken out of the business, and as Exxon, of course, mentioned today, at a larger scale, what they're trying to do on the trading side, trading throughout the business along the value chains and across their value chains.
Roger, Ness here. And ExxonMobil, a lot has been talked about the cash that ExxonMobil sitting on and whether or not it would acquire Pioneer. There's been a recent report about eyeing an acquisition. Do you see something like that happening? And if not Pioneer, which?
Always a tough question to answer for the company or for us. So I think, if you look at what's typically made M&A work in this space, it's more often occurred during a time of stress, meaning low commodity prices or some other, exogenous event that creates reasons for mergers. Doesn't mean it can't happen, just we would be saying watch for those moments as opposed to just waking up one day and seeing something. The other thing to watch, though, of course, is the quality of the asset that is being considered, right? So no question the companies that have been mentioned out there for consolidation have those quality assets. But I don't want to go too far down that rabbit hole because, it's all conjecture at this point.
But if they were to be looking for an acquisition, without going too much into the rabbit hole, would they be looking for future drilling sites, or would you think of more of an acquisition to sort of increase their profile when it comes to decarbonization, let's say?
I think it would all go hand in hand. And if you look, the Permian Basin is actually a fairly competitive area in terms of carbon intensity. And the other big thing that's obviously gone on in the Permian Basin and everywhere else, getting rid of flaring, getting rid of fugitive emissions and so forth. So I think any transaction done would have that in mind. But broadly speaking, the Permian fits within those or within that framework. So I'd be comfortable on that. I think the main reason you would see any kind of transactions, though, is to do a couple of things. One, obviously create value, right? It's got to be an accretive deal or what's the point? I think the second part of it would be, the Permian Basin recovery rates out of shale wells only runs about 10% these days. If you look at more conventional fields, the recovery rates range from sort of 30 to a little over 50%. So part of buying this acreage would be thinking about it from a multi-decade standpoint, right? How do you get, double 10 to 20? It doesn't have to go to the 30 or 50, but you would get yourself to a level where there's tremendously more resource in place than what we're just looking at today, thinking how many shale wells can I put in at a 10% recovery factor?
At the same time, Roger, they're getting a lot out of what they do own, and they're getting a lot out of their existing businesses, right, as evidenced by this quarter. I'm curious, with oil prices where they are today, do you forecast any expansion there? Because you would think, if we're looking at this record first quarter, if oil prices trend higher from here, that would be gravy for these guys, right?
Yeah, and I think that's more or less how they look at it. It's fair to say in a couple of places, right, taxes have gone up. And as these companies get further removed from the COVID era, the terrible oil prices in 2020, you're starting to see, cash tax rates go up. So it's not all, straight to the bottom line. But I think, again, I mentioned at the beginning, they have really reduced the costs in these businesses across the corporation. So you're seeing a pretty big drop down for, relatively modest increases in oil prices would have a pretty big impact at the cash flow and profitability lines.
And when you look at Exxon versus Chevron, I know you've got an overweight on Exxon. Do you think both of them are a good buy right now? Is there one you prefer over the other?
So we have overweight ratings on Chevron and Exxon in terms of, preference. I think it's about equal to our price target. So there's not one that's just dramatically standing out from the other. But if you look at the way these companies are operating and their cash returns to shareholders, so take the dividend plus the share repurchases, I mean, both of them are considerably more compelling than just say the S&P 500 as a whole. And we think that's really what you'd want to pay attention to is, you obviously want to have a view on oil prices and expectations there. But if you have a reasonably positive outlook for the economy, a reasonably positive or stable outlook for the commodity prices, what both of these companies are doing is, like I said, definitely outperforming, the broader market.
And we talked about oil prices and where they're at and if they continue this way. But what if we hit a hard landing and a recession and oil prices go down significantly? What if diesel and gasoline consumption goes down? What happens then?
Yeah, I mean, I think it's fair to say we've never seen the energy space ignore a recession, right? We've had periods where it was considerably more impacted and periods where it was less, right? So you could go back to the early 90s, and even though oil prices were quite volatile in 2008, we really saw energy come through the global financial crisis with, relative unscathing. So I would say is, having seen the severity of what happened in 2020, the impact on spare capacity, the impact on reinvestment trends and so forth, our view is energy is relatively better positioned for any kind of, recession, be it mild or something more severe. Now, that said, Wells Fargo's economics department has an outlook for a recession. We factored that into our forecast. We expect oil to go under $70 around year end, meaning the Brent oil price. So, if you look at our numbers, you look at our expectations for these stocks, we've got a mild recession factored in, and yet they still look pretty compelling.
XOM is up 8% year to date. Chevron down 7% year to date. Today, Chevron is flat right now. Thanks so much, Roger Reed, Wells Fargo analyst. And coming up.
Thank you.
Overstock delivering a surprise revenue beat after several disappointing quarters. We've got CEO Jonathan Johnson on the other side of the break. Stay with us. Overstock reported revenue that came in ahead of estimates in the first quarter, though down 29% year over year. The company also reported a smaller than expected loss. Let's dive deeper into the quarter with Overstock CEO Jonathan Johnson. Jonathan, thanks so much for joining us. During the earnings call, you talked quite a bit about the lean into the strategy that you have for home furnishings market. So can you talk to us a little bit about that? How is that strategy going?
So we are just about 1 year into being 100% home furnishings and furniture company. It's going well. It was a purposeful and intentional decision that we made because our home customer tends to visit the site more frequently, has a higher conversion rate, and a better average order value. Now, it's been a tough time to do it as hard goods have come down a little bit as consumers have shifted toward experiential. But we still think it was and is the right decision for us.
Hey, Jonathan, it's Julie here. It's good to see you. There's some interesting things happening in the competitive landscape right now. You talked about one of them on the call, and that is Bed Bath & Beyond declaring bankruptcy, which you said maybe could be beneficial to you in terms of market share. On the flip side, IKEA is announcing a big expansion, right? Planning to open a lot of new stores in the United States. So where do you guys sit in terms of that competition?
Yeah, large and fragmented market. There's a lot of white space, and so anytime someone goes out of business, creates more white space for us, and it's an opportunity to capture market share. Something we've been, focused on for several quarters is Bed Bath & Beyond was on the ropes. We expanded our small appliance and, consumer giftables. Think KitchenAid and Cuisinart and Keurig and Mr. Coffee. So we've been competing there. IKEA's expansion is more of the brick and mortar space. We're wholly online. We think our product is different than the product that IKEA offers. They're a worthy competitor, but we think we're in a little bit different space than they are.
Can you talk to us a little bit about the consumer, how the consumer is doing? I know that during the earnings call, there was some talk about evidence of a trade down, also signs of deflation. Expand a little bit on that.
Yeah, so as we've worked to expand our product assortment, it doubled in the last 2 years and then was up nearly 20% again in the first quarter. It's really expanding in the good, better, best mentality. And it has become more important that we're strong in the good and the better as consumers trade down. It's also important that we have strong loyalty offerings. We have a new credit card offering with Citi Retail Services that provides 0% financing for 12 months. And we're seeing a little bit more uptick on our buy now, pay later offering. So consumers are willing to spend. They just want the deal. And sometimes that deal means better pricing. Sometimes it means better financing.
Yeah, it's interesting that you talk about that because we really see, and you talked a little bit about promotioning on the call as well. We've been talking all week about pricing power, but it's really limited to food, for example, personal care, not happening so much on the apparel side or on the home decor side, right? I mean, what are you seeing in terms of that promotional cadence and trend right now?
Yeah, so I think there's still a little bit of an inventory glut in the home space. We saw this start kind of last summer, and so that's pushing prices down. I also think that as the supply chains freed up, people are trying to get rid of what is more expensive inventory to bring in new, fresh, probably less costly inventory that will push prices down in our space over time.
And we've heard a lot of companies talking about AI, machine learning. What do you, are you using any of that when it comes to your pricing strategies, when it comes to the way you sell?
Sure. I think a lot of potential uses for AI, helping product descriptions be better, helping customer service certainly can be used in pricing. So still early days, but we're working on projects using generative AI that we think will help our business and help us run even more efficiently, which anytime we can be more efficient, that should increase sales and put dollars on the bottom line too.
Hey, Jonathan, I want to switch gears for a minute and ask you about Medici Ventures, which is basically your venture capital arm that invests in blockchain, because there's something I'm confused about, and that is T0. My understanding was that T0, which is a crypto exchange that is funded by Medici in part, was closing down, but you talked about it on the call. So what's the status of T0?
T0 is up and running. It has focused. It had a crypto wallet, which it shut down to focus more on its token business to help companies raise money in the capital markets using a token. We're still very bullish on T0. We love its partner. We're co-investors with ICE. We think no one knows how to make markets better than ICE does. And so we like what's going on there. We hope that our investors dial into our Medici Day on May 31st to learn more about some of the companies in that Medici Ventures portfolio.
And is Medici a revenue contributor for you guys yet at all? And if not, do you expect it to be at some point, maybe when you start exiting some of these ventures?
So it's not a revenue contributor, but when there are exits, we do expect it to help the balance sheet. When there are exits for any of these investments, and whether it's going public or a sale or something like that, our ownership interest will be cashed out, and that will be a nice balance sheet event for us if that's to happen.
All right, we'll keep in touch with you about it. Overstock CEO Jonathan Johnson, thanks for joining us. Appreciate it.
You're welcome, and thank you.
Coming up, Intel suffering its biggest quarterly loss in the company's history, with revenue nosediving as the chipmaker battles inventory corrections in the PC market. We'll discuss what's next on the other side of the break. Intel beat expectations yesterday after the bell, but it reported its largest quarterly loss in company history, coming amid a steep decline in both PC and data center sales as consumers and businesses pull back on spending. Joining us now is Bernstein's Stacey Rasgon, who covers U.S. semis. And Stacey, The title of your note, I have to say, gave me a little chuckle this morning. When you're already on the ground, it's easier to look up. In other words, like, things are pretty bad for Intel, so even some kind of little marginal improvement is seen as good news by the market. Is there going to actually, do you think that improvement is going to materialize?
Yeah, so look, like, stocks are, it's a matter of expectations, which is expectations versus reality in that gap, which is what drives stock prices. And like, don't get me wrong, objectively, this was a horrible quarter. And the guide objectively relative to where they had been running for many, many years was horrible. However, they set the bar much lower than that. And expectations have been rock bottom, and that's sometimes that's all it takes. I mean, the big question people are trying to answer on Intel is it as bad as it can get? And from what we heard last night, the answer to that plausibly could be yes. It could be as bad as it could get. They are looking for a bit of a recovery in the back half. They use the word modest, although there is enough there to maybe believe that it could be better than modest. They've got people excited now about gross margins getting back to 40%, which again is an unbelievable kind of statement. You never would have thought they'd be this low in the first place, but we're at the point now where I think you can plausibly make the case that we'll see how long it takes for things to get better. I don't know, but hopefully things can't get worse from here, and that's why the stock is up today. Even in the midst of a horrible quarter, expectations were even lower. Sometimes that's all it takes.
Yeah, Stacey, that was my question. So the stock is up 6%. Is it because they've reached bottom and it's only up from here?
Well, we'll see if it's up from here or not. I don't know, but they probably have reached bottom. Like Q1 was so bad. I think everybody's been bandying about, the biggest quarterly loss in their history. Yeah, it doesn't really get much worse than that. Revenues collapsed. They did beat expectations by them because they set the expectations so low, but revenues were down a ton. They were down, I think both their PC and their data center businesses were down almost 40% year over year. Gross margins are now well into the 30s. Free cash flow, they burned $9 billion in free cash flow in the quarter. I mean, it was pretty horrendous. Q2 is going to be bad, but it won't be quite that bad. And they're looking for things to get better in the back half. So yes. And beyond that, call me in a few years. We'll see.
Go ahead. What's the risk to that? If you said the second half of the year, a recovery is plausible in the second half of the year, but what's the risk? What if we hit a hard landing, a recession?
Yeah, so let's talk about what's driving some of that back half. So in client, if you go back to the last couple of years, PCs, as we know, were very strong. CPUs, the things that Intel ships, they were actually over shipping PCs by a very wide margin. Because of all the shortages and everything else that we had. So now PCs have corrected and their shipments have gone from over shipping now to under shipping. And they think in Q1, they actually undershipped the market by 20%. So that doesn't last forever. And so even if PCs didn't grow, at some point you go from under shipping by 20% to shipping in line. That's actually a pretty material lift, like half over half, right? If that normalization happens. And it should happen at some point. In data center, again, it's been very weak. Enterprise in China have been weak for quite a while. Those may start to they'll probably hit bottom. Those may start to get better. They've got new products that are launching in the back half with higher prices. They talked about a little green shoots in China maybe. So again, plausibly, you can argue that can get better. What would be the risk to this? Clearly, there's a demand in a macro statement. Yeah, if we hit a hard landing and they're looking for PCs for the year to come in around 270 million units. I'm closer to 250, but fine. What if they were 220 because macro was horrible? That would be a risk. That's not strictly an Intel risk. That would be like an everybody risk.
But some of this stuff is an Intel risk, right? Like some of this stuff has nothing to do with the macro. It's Intel specific, right? So how do they fix that stuff? Are they do you feel like Pat Gelsinger's on the right track here?
I don't know yet. It depends, right? So in terms of fixing things, like I said, things are already bad. It's hard for them to get worse. And some of what we're seeing in terms of the low revenue is because they are flushing out inventory from the channel. They are under shipping end demand. That should get better once the channel inventory is normalized. So that's something that they're doing, which is okay. But I'd say on the client side, on the PC side, their roadmap looks pretty good. And on the data center side, the products have been delayed, but those products are finally ramping. They have new products that are coming next year They had a data center event a few weeks ago where they kind of talked about that being on track. Maybe those will slip. I don't know. I don't have a ton of confidence, but if they do slip, they don't have to tell us about it for almost a year. So at least for the next probably 4 quarters, everything's going to look like it's on track. In terms of the broader strategy, so look, they're investing a ton of money. They're trying to build a third-party foundry business and everything else. It's painful. Now, you could argue it's the right strategy in the sense that if Intel wants to have a robust and viable company 5 years, 10 years down the line that is competitive with the best in the world, they're probably doing the right thing. They have to invest heavily to do that. Their mistake was setting expectations so high. Like, I don't know why Pat came in and just sounded so bullish. He should have come in and said, look, we think we're on the right path, but you guys have to be patient. It's going to be a slog. And they didn't really do that. But if that's the goal, that's the right strategy, because their alternative kind of, it's to lay down and die, right? You turn it into IBM. Like, we're not going to invest. We're just going to, manufacture earnings and just sort of manage a business in decline. Like, that is a model. You can run a company like that. That's not what Pat came in to do, and that's not what the strategy is. So in 5 years or 10 years, maybe this is the right strategy. But the problem is we won't know if it's going to work for 5 years. That's the biggest problem with owning the stock structurally here. Even if it's off the bottom, we upgraded it a few weeks ago on exactly this thesis that probably it can't get any worse. But doesn't mean I want to own it, because the problem is I have no idea what the company looks like in 5 years. It's impossible to know at this point. And given that uncertainty and the fact that even if what they're doing is the right thing, that the chances of success are not guaranteed, I think it's a hard thing to own structurally.
Stacey Rasgon, Bernstein research analyst with a market perform rating and a $30 price target on Intel. Thanks so much for joining us.
You bet.
Coming up, inflation may still be high, but that hasn't stopped spending on makeup and beauty products. A deep dive into the beauty and makeup market next. If first quarter sales are any indication, beauty may be recession-proof. 70% of shoppers say they're not cutting back on beauty spending, even with inflation pressure, according to a recent Circana survey. Larissa Jensen, Circana Beauty Industry Advisor, joins us now with a deeper dive into first quarter beauty trends. Larissa, so 70% of respondents saying they're not cutting back. What makes beauty so recession-proof?
Well, I think it's that consumers are going to make choices that reflect what's important to them, right? So if you think about beauty products, they bring joy. It's a universal aspiration and the goal. Now, if you look at the results for quarter one in terms of beauty, we look at the market in two different ways. So there is the mass market. So these would be beauty products that are sold in food, drug, and mass channels. And then there's the prestige market. And these are beauty products that are sold in department stores and specialty stores. And when you look at the performance for so far in the quarter, you can see that statistic about the 70%. It's showing through there with double-digit growth happening across both the mass and prestige markets. So that is a very positive sign. What's really interesting, though, is when you dig beneath that level of dollar growth and you look at unit growth, what's happening is that the prestige market is actually what's growing faster. It's growing units double digits so far this quarter. And in the mass market, we're seeing a unit performance actually somewhat flat, which means that the growth we're seeing in the mass side of the market is really driven by average prices. So when you think back of what does that mean? It does tie into that treat mindset. And it really is, lipstick is one of those things. You think about the lipstick index, you've heard of that, I'm not sure. But basically that says if, consumer sentiment starts to decline, they look for that pick-me-up and they look for a way to make themselves feel better. Like I had said, beauty brings joy. But what's interesting is that we saw that playing out across all of the categories. So as you can see, we're seeing growth across makeup, skincare, fragrance, hair products. Consumers are turning to these products as a way to enhance their mental wellness.
Well, listen, we could have a whole philosophical and cultural discussion over that phrase, beauty brings joy. And it's a loaded one, but it's not that kind of show, as they would say. So, Larissa, what's interesting to me is you talk about the difference between prestige and mass market and what's happening with the price side on mass market. I mean, that's happening on the prestige side as well in terms of pricing, is it not? In other words, because of innovation in the beauty industry, we talked to somebody yesterday, for example, at Oddity, which owns Il Maquillage and Spoiled Child, and they talked about the development of new molecules and yada yada for beauty. I mean, that too, we're seeing some pretty significant price increases on the prestige side now.
So yes, we are, but at a total level, the average prices for prestige are actually somewhat flat. Now, if you look down and you look at makeup versus skincare versus fragrance, you're going to see some fluctuations there, and you're going to see, example, fragrances have a much higher increase in average price than, say, skincare does, right? But I think what's really interesting when you look at the dynamics of prestige beauty and that unit performance, I think says so much, right? Circana tracks $3 trillion of consumer spend. We're looking at CPG industries like grocery. We're looking at general merchandise industries like apparel and technology and toys. Only prestige beauty grew units in 2022 and is growing units so far in 2023 across all of those industries. So you could see some of those industries are growing in dollars, but none of them are growing in units with the exception of prestige beauty.
Are there certain categories that are growing more than others? I mean, you mentioned that they're all growing, but when it comes to makeup versus skincare versus hair care versus fragrance, is there one that's beating out the other?
Yes, and it's something that we have been anticipating and expecting, but makeup is the #1 fastest growing category across both the prestige market and the mass market. So it's growing double digits in both. And it's also one of the few categories that is growing units in both mass and prestige. So that is #1, hands down, the fastest growing category. That is actually followed by fragrances. I talked a little bit about that shift in that mental wellness component. Fragrances has really fallen into that. Consumers are looking to fragrances as a way of meeting as a form of self-care, I should say. So we know that consumers are going to scents to lift their mood, to provide that wellness benefit is what they're looking for. So fragrances is the next strongest category, followed by skincare and hair.
Look forward for us to close this out here, Larissa. Is this going to continue? Typically, if we actually enter a recession, how well do these trends hold up?
So last year, when we saw a big dip in consumer sentiment, is when we started to see that increase in lipstick sales, right? And then as consumer sentiment started to pick up at the end of last year, we saw a continued growth. So it's almost like, our industry is so resilient. Whether, we go into a recession or not, either way, we will probably be seeing some strong growth from the beauty industry, regardless of any headwinds that swirl around us.
All right, we'll be watching these companies. Thanks for your perspective, Larissa. Larissa Jensen, Circana Beauty Industry Advisor. Thanks.
Thank you.
Well, elsewhere, we're watching shares of First Republic plummeting. It seems the bank's hopes for a rescue could potentially be in jeopardy. David Faber over at CNBC reporting that sources are telling him the Federal Deposit Insurance Corporation could likely take the bank into receivership. What does that mean? Well, that's what happened with Silicon Valley Bank, right? The depositors at Silicon Valley effectively got bailed out, got backed up by the FDIC, but those holding the bank's debt, holding the bank's equity, did not. So that could be why we are seeing the shares plunge to such an extent on that report. Meantime, coming up in just a few minutes at 11 a.m., we are expecting to get the Federal Reserve's report on what went wrong at Silicon Valley Bank and why that bank did indeed collapse. So Inez, really interesting action. And also interesting that even with this report about FRC, if this had happened 2 months ago, the whole market could have been affected. But that's not really happening right now.
Yeah, that's right. And we have seen the stock really gyrate this week. I mean, we saw it go lower earlier this week than we saw a bounce back yesterday. But if we just take a look, right now it's down 25%. Year to date, it's down 96%. And most of that has happened over the last month or so. So you're seeing, or over the last 2 months, really, you're seeing this stock completely plummet from where it was before.
And we do have a statement from a First Republic spokesperson, by the way. We are engaged in discussions with multiple parties about our strategic options while continuing to serve our clients. Again, a spokesperson for FRC making that comment to us. There have been reports that the bank was continuing to push for asset sales to various parties, but we have not yet seen any announcement of those materializing. So again, the shares are slumping. We will have that Federal Reserve report on what went wrong at SVB in just a few moments, and we'll keep you posted on FRC as well. Inez, thanks for sitting in today.
Thanks so much for having me.
Fun Friday. Have a great weekend, everyone. Rochelle's got you for the next hour.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. The Great Divide, the biggest platforms in tech, still seeing oxygen in the digital ad market. But it's a different story for Snap and Pinterest. We'll break down a big week in the tech sector. And the Fed's report on SVB breaking imminently, but even so, the banking risks haven't disappeared. First Republic shares halted as bailout speculation grows. And the largest quarterly loss in its history. Not great reading for Intel investors or anyone concerned with the health of US chip making. CEO Pat Gelsinger joins us this hour. But first, let's check in on the major indices right now. We're looking at a mixed picture at the moment. We're seeing the Dow there, at least positive, but just barely there, up about 54 points on the day. We're seeing Visa helping lift that. Meanwhile, Walmart under a little bit of pressure. Also taking a look at the S&P, up as well, but ever so slightly, just barely there, about 4 points there. Consumer discretionary and communications, the weakest performing sectors there. And looking at the tech-heavy Nasdaq, still in the aftermath of what we saw from earnings and the forward guidance we got from Amazon on AWS Cloud, really weighing on investors there at the moment. Let's also check in on the Treasury market as well. We saw that core PCE came in a little bit hotter than expected year over year. So taking a look at that, that's one of obviously the Fed's favorite inflation gauges. The 5-year down about 1.9% there, the 10-year down just over 2%, and the longer term 30-year yields there down about 1.9% as well. Right, the Fed out with its report on why Silicon Valley Bank failed, calling it, quote, a textbook case of mismanagement. The Fed's Vice Chair for Supervision, Michael Barr, saying senior leadership failed to manage basic interest rate and liquidity risk. Yahoo Finance's Julie Hyman is here with us with the latest. Hey, Julie.
Hi, Rochelle. Well, the blame is not just laid at the feet of management of Silicon Valley Bank in this relatively scathing report here from Michael Barr, that Vice Chair for Supervision at the Fed. In addition to management saying that they failed to manage their risks, it was also supervisors, bank supervisors, who did not fully appreciate the extent of the vulnerabilities at the bank, even as those vulnerabilities worsen. And then the report finds once the supervisors did realize what was going on, they did not take enough steps to make Silicon Valley Bank fix the problems that we had. And then finally, that basically the way that the Federal Reserve Board had structured supervision was also at fault here and limited the ability of those supervisors to take measures. And so essentially, Barr is saying now what needs to happen is some changes need to occur on the regulatory front in order to make sure that something like this doesn't happen again. And he's talking about that he would potentially undo some of the rules that we have seen governing regional banks. Remember that were loosened in part because of lobbying of banks like SVB at the end of the last decade. So a lot to go through here in this report, but the big picture takeaway is that yes, management was definitely at fault here, but it was also the system that failed the bank as well, and supervision of the bank that failed.
And we know that we're continuing to see some of these dominoes fall. We're seeing sources telling CNBC's David Faber that First Republic likely headed for FDIC receivership. We see the shares here already under pressure. What more do we know about that?
We don't have much more information at this point in time. We know that First Republic has been gyrating wildly, the shares in recent days, on various bouts of speculation and waves of speculation. There have been reports that First Republic was trying to offload assets, but we had not yet gotten any kind of announcement of buyers of those assets. You can see the shares are down 30% right now. They're down some 90 to 95% this year. If the FDIC does come in and take it into receivership, that's effectively what happened at Silicon Valley Bank as well. What would it mean? It would likely mean, we don't know the exact details, or even if it's happening, this is an unconfirmed report, just to stress here, it would mean the depositors would likely, if it was like SVB, the depositors would be made whole. They would not lose their savings or other deposits that are placed at the bank, but it would likely mean that equity holders of the stock would be wiped out here, as well as in the case of SVB, the debt holders as well. So it's not sort of a classic rescue, if you will, in some senses of the word historically that we have seen for companies and banks, because the investors would not be made whole, but potentially the depositors would. So we await any kind of confirmation on this. We did get a statement from First Republic Bank as well that I just want to reiterate here. A spokesperson for the bank saying, we are engaged in discussions with multiple parties about our strategic options while continuing to serve our clients. So no kind of confirmation from the bank itself of what is going to happen next, Rochelle. But investors, traders are selling first and trying to get that confirmation later, it seems.
Indeed, and we'll have more on that. We'll be breaking more of that down with former FDIC chair coming up later on in the show. A big thank you there to our very own Julie Hyman. All right, turning now to the tech earnings dominating this week's stories. The advertiser pullback continues, creating a mixed picture for tech companies. Google seeing its ad revenue dip even as it beat expectations. Meanwhile, Meta, one of the few bright spots in the industry, seeing growth in its advertising due to reopening in China. And even Amazon, out with earnings yesterday, starting to emerge as a company to watch in the ad space. Joining us now with more is Yahoo Finance's Dan Howley. So break down this difference that we've seen with these different tech firms.
Yeah, well, let's start with Alphabet and Google right off the bat. Their advertising revenue went from $54.6 billion to $54.5 billion in this quarter. That's from Q1 2022, by the way. That difference really shows that they still aren't on a path to recovering in this kind of ad market environment. Look at YouTube ads as well. That was also down slightly from $6.86 billion in 2022 to $6.69 billion last quarter. So obviously they still continue to struggle. On the flip side, we have Meta, Facebook parent company Meta. They seem to be righting the ship after 3 consecutive quarters of revenue declines. They've turned that around and they are doing better in the advertising space. We also have, as you mentioned, Amazon, which has continued to push itself deeper and deeper into advertising. They saw revenues increase this year. It jumped, I believe, 21% year over year. If you adjust for FX, though, or if you exclude for FX, though, excuse me, they had dropped from, let's see, they had 25% growth year over year in Q1 2022 down to 23% this year, though they had that 21%, which was actually up from 19% when you do factor in FX. So obviously they're doing well in that space. And then, we just look at the likes of Snap and Pinterest. Snap is just a story that, I mean, woof, that has not been great. I was following the earnings yesterday. You just saw the stock price get slammed after they announced their poor performance. And, we look at Pinterest and they announced a deal with Amazon, basically saying, look, we're going to let Amazon run ads on our platform for different goods. People will then be able to click into those ads and purchase them directly through Amazon in one click, since most people who are likely using Pinterest are also Amazon users, and they can just get their account set up right away. So the advertising space really does continue to remain challenged, but there are some winners, quote unquote, at this point, and it appears that Meta really is the one that's seeming to pull away. There's a lot of talk about how they've really kind of optimized with AI. That was something that Mark Zuckerberg has talked about. I mean, you could basically throw AI in any conversation at this point, and investors are going to go nuts because, I mean, it's basically the hot topic at this point.
And you mentioned that Pinterest deal with Amazon there. Talk us through how that works. Because I know sometimes when you go on Pinterest, it's a bit haphazard. You almost have to fight to spend your money when you click through some of the tabs there.
Yeah, they've been trying to really kind of change the way that they operate, or at least the way that consumers look at it. With rivals like TikTok and Instagram moving more towards Reels, it's, a photo board really isn't the hot thing that people want. So they've been going more towards videos, more towards creators, getting people more interested or trying to get more people interested into the platform. And so with this Amazon deal, what'll essentially happen is if you're perusing Pinterest, you see something you like and it happens to be an Amazon ad, you can click into it and then you'll just be taken directly to Amazon to purchase it. So it'll make the experience a lot easier for consumers. And this means that Amazon is going to get a cut of those sales, and ideally Pinterest will as well. They don't really give full terms of the agreement in the announcement, but you can imagine that, they're both going to benefit in some way. And I think this is something that is obviously beneficial to Amazon because they're getting the sales done, but also because, their advertising platform just continues to grow. I said, obviously there's been some decline in growth, but still growth. And that really just goes to show that the strength of appearing on their top spot when it comes to products, video ads, anything along those lines. Amazon just continues to grow. And this was a footnote a few years ago. And just as they've built this out, it continues to be a more important part of the equation for them. It's not going to become, the sole purpose for Amazon. AWS and actual retail sales are going to continue to dominate. But where you see them struggling when it comes to retail, they do have this kind of third leg to kind of stand on. Again, it's not nearly as big as that, but it is something that's growing and could help them kind of even their business out when they go through times like this.
Indeed, especially as, trying to meet consumers where they are. And, they are on Pinterest. Pinterest, though, having trouble monetizing what they're seeing with their popularity with consumers. But a big thank you there for breaking all of that down for us, Dan Howley. Right, well, Amazon's ad take, something of a story in itself, seeing growth in that space yesterday. It even outpaced its powerhouse cloud services unit. The e-commerce giant beat on earnings, providing investors with a very brief sigh of relief as they come to terms with its warning of reduced spending. Joining us now is Arun Sundaram, Senior Equity Analyst at CFRA. Good to have you on the show. I mean, we saw what happened when the numbers first came out with that top and bottom line beat, but then that very cautious tone in that call. So do you think when you look at sort of the stock reaction today, are investors rightfully concerned?
No, I thought the reaction was a little overblown. Obviously they had a really good quarter. They beat on the top line, they beat on the bottom line, and even the guidance was good. It was really during the earnings call when we got a little more color on AWS. They noted that in April, AWS was running at around 11% year-over-year growth rate. So that's down from the 16% growth rate that Amazon experienced in Q1. And that really sent the shares south. And I think that's where a lot of investor concern lies. And now I think a lot of investors are worried, hey, AWS growth hasn't bottomed yet. Could we be entering a single-digit growth rate for AWS? I think that's what's on a lot of investors' minds. If you ask me, potentially we can go to a single-digit growth rate in AWS, especially if we do hit a recession here in the US. But when we view those headwinds as mostly transitory, longer term, we see Amazon really well positioned in cloud computing, in AI, and I think it's just a matter of time before that growth rate reaccelerates to that double-digit, those high double-digit growth rates that we're used to seeing.
And they did emphasize on the call that this isn't just about sort of, one quarter, really taking that long view about where AWS is headed from here. But how much did some of that current commentary change, really move the needle for you in terms of where you see Amazon heading this year and next year now?
Yeah, so I mean, our thesis for this year is really, on that retail segment. It's not really necessarily on the AWS segment. The retail segment, I think this past quarter, it showed some resiliency. We did see better than expected results in the e-commerce sales, both first-party e-commerce sales and third-party e-commerce sales. I think the story for this year is really improving the profitability in that e-commerce business, which hasn't been profitable for over a year now, given the high cost to serve. But now Amazon is cutting costs in their e-commerce business. They're realizing more efficiencies. And I think we're just starting to see the beginning of that this quarter. We'll likely see more efficiencies flow through in the coming quarters, and not even this year. I think we'll start to see some more efficiencies in the e-commerce business next year. So we really view Amazon right now as a multi-year turnaround story in terms of profits and margins, and that's why we're positive on the shares.
So then, in that multi-year turnaround, then do you still see Jassy as the best person to lead that growth story?
Yeah, we do. Jassy used to be the head of AWS. Right now AWS growth is slowing, but if anyone, he's probably the best person to oversee that business as well. Like I said, I think a lot of the headwinds right now are more macro oriented versus company specific, and that's just the truth of what's happening in the macro environment right now. Like I said, I think right now the big focus is on improving profits and margins, and this quarter was really just the start of that. And I think like I said, I think we'll start to see better profits in Q2, Q3, and even flow into next year in 2024.
And when you were going into this earnings season, we were going to hear a lot about these macro pressures and how different companies were navigating it. And we did also see a very strong focus on really optimizing the customer experience. Jassy expecting the fastest ever Prime delivery speeds in 2023, and also talked about AI's role in things like inventory management and ad placement as well. What do you think is going to be that next growth story for Amazon from here?
I think there's a few growth stories, because Amazon is just it's an ecosystem of products and services. They're an e-commerce company, they're an advertiser, they're a cloud computing company, they're also a large transportation company as well. And now they're getting bigger into healthcare. They recently purchased One Medical a few months ago, so they're getting bigger and bigger into healthcare. They're also placing bets into communication services. They have a project right now called Project Kuiper, which is launching satellites into space to try to provide broadband internet to underserved parts of the world. So there's lots of different businesses inside Amazon right now, but I think right now the priority for 2023 is focus on its core business, and that's mainly because of the weaker macro environment. Because you only have fixed resources, you can't really spread that around to every part of the business. So I think the focus this year is really focusing on the core business, which is e-commerce, advertising, and AWS.
We'll certainly be tracking that as well. A big thank you for joining us, Arun Sundaram, Senior Equity Analyst at CFRA. Thank you. Have a great weekend. All right, coming up, the largest quarterly loss in its history. Not great reading for Intel investors or anyone concerned with the health of US chip making. CEO Pat Gelsinger is next. You don't want to miss it.
Intel suffered its biggest quarterly loss in company history, with revenue dropping 36% as the chipmaker battles inventory corrections in the PC market. The company is in the midst of a massive turnaround campaign led by CEO Pat Gelsinger, who's looking to take back market share from rivals in the chip space. Pat Gelsinger joins us now. Pat, always nice to get some time with you here. So a little different story today in terms of the stock market reaction compared to the previous few quarters. Shares of Intel up here almost 6%. What do you think investors are taking away from the quarter?
Thank you, Sazi, and always great to be able to join you and the Yahoo team. It was a meet, beat, raise quarter, and we were able to beat on the top line. We were able to beat on the bottom line and increase guide for next quarter. So I think everybody says, wow, that was a good quarter. We obviously did so through very challenging macro environment, market conditions, and being able to demonstrate great cost discipline as well. So all of the steps of our turnaround are underway. Good execution on the product side, good execution on the process technology momentum that we have. And I think investors are looking at it and seeing a bit of the green shoots, as we've described, that's starting to emerge in the Intel turnaround story.
Pat, one question I've gotten over the past 12 hours or so after the earnings have hit, we are unclear, this is mostly from the analyst community, are we unclear if the bad news from Intel is done? How do you see it?
Well, we have to look at that across the different market segments. And in the PC market, we'd say, we think we're seeing that turnaround. Inventory reductions made substantial progress in Q1. We think they're finished in Q2. We feel like we continue to gain share in the marketplace, and we have a very strong roadmap of products. So in the PC marketplace, we're actually pretty optimistic that we've bounced off the bottom and now we're starting to see a good trajectory. In the data center and cloud market, hey, it was a tough quarter, but even there, we did better than people expected, and we think we were able to hold market share. And I called it a turning point in the data center market. One where we've been fighting for a while, and we had to fight through some poor product execution. Our next generation Gen 4 Xeon, the Sapphire Rapids product, ramping very well, hitting 1 million units, and all 4 of the next generation products, the second half of this year, key new products for next year. On our next generation process technology, Intel 3 looking very healthy. The market is seeing us deliver those before they expected. So all of that is reinforcing product execution as well as process execution. And that combination is saying, wow, these guys are really starting to lean in, tough market, but they're starting to stabilize. And as I said, the first moment that I see these glimmers of hope in the data center business, tough inventory in the networking markets and edge. But even there, we're starting to see that, hey, have a good handle on this. We don't think we lost any market share. It's just overall tough market conditions. And obviously, globally, we're starting to see China start to emerge a bit more. And a second half in the tech industry is definitely stronger than the first half in most years. So all of those put together, we're a bit optimistic that Q1, improvement in Q2, and improvement through the second half of the year.
Someone shot me a note, Pat, telling me that Intel 3 could be a real potential stock mover for your company. What is Intel 3, and when will it start showing up in your financials?
Yeah, Intel 3, that's, we said 5 nodes in 4 years. Intel 7, Intel 4, which is Meteor Lake, which ramps in the second half of this year. Intel 3 is the next year process technology that we're basing our next generation server products on, what we've called Granite Rapids and Sierra Forest. And when we said that we were delivering the first one of those Sierra Forest in the first half of next year, I think everybody says, wow, that's a little bit sooner than we thought on a leadership process technology like Intel 3. The combination of a stronger server product on a stronger process technology gave everybody in the marketplace a bit more confidence than I think people expected. And with that, we're obviously be building that in the U.S., a key process technology for U.S. manufacturing, but also for our foundry business as well. And I think that combination of getting back to leadership in the data center with leadership process technology, everybody's looked at that and says, wow, they're starting to get their execution mojo back. And I think that was one of the things that I was most proud of my team in the first quarter, really executing product, process, and financial discipline.
It was an interesting week for earnings, Pat. You had Microsoft and Google, I would say, had earnings call battles in terms of AI. I think they took some thinly veiled shots at another, but that's just me reading a lot into these calls. Where does Intel fall into this generative AI discussion?
Yeah, and I think, I like to think about the AI discussion in 3 parts. One is you have these ultra high-end machines for large learning models, where you're now talking about hundreds of billions of parameters that run for months to see stabilization of the model. And there's few that can create those models. And Microsoft and Google being 2 examples that can invest in these very high performance computing environments. And I sort of think about that, Sazi, like weather simulations. Only a few have machines big enough to build them, but then many need to use them. And that's what we call learning versus inference. And inference is one where we say everybody wants to be able to take advantage of those large language models, but using them, not creating them. And that's really, where the second layer of this comes in. And we're starting to compete for the large language models. We have a new component called Gaudi 2, right, which is setting performance records for those largest training environments. But Intel is much more about democratizing AI. And that's where products like our Xeon Gen 4 Sapphire Rapids, strong performance on AI, helping customers to inference. And we see inferencing to become the dominant AI workload and an area of more natural strength. But then we also say the third piece is we need to enable the entire software ecosystem across every platform that we deliver. And our next generation client, for instance, has a lot of AI capabilities because you'll be able to do things on the client, generating your text, being able to do eye movement in your Zoom, being able to do real-time language translation in your Teams call, but also then at the edge, right, where you'll be using inferencing for in-store analytics or for security. In the data centers of our enterprise customers, where they want to be able to take those big models, but use it locally with their data without eliminating any of their restrictions around security and data privacy. And finally, helping for those super ultra large language model creation. So we're driving a software environment that enables everyone in the world. Generative AI becomes mainstream with democratization of AI, and that's where Intel comes in.
So in the past 7 minutes, I've heard you talk about you have an AI strategy, that's good. Potential turn or turning the corner, green shoots in the PC business. Data center, maybe some green shoots at the back half of this year. I mean, how powerful do you think a turnaround will be at Intel? Because I think there are some folks questioning the earnings power of the company 2 or 3 years from now.
Yeah, and obviously we have a lot of work to do yet in that regard. But I think everybody's looking saying, hey, they're starting to do what they said they would. We said we have to get back to process technology leadership, well underway in our discussion on Intel 3, an example of that. Product leadership, multiple generations of client products, regaining share in the client. Data center, the product, a little bit better than we thought. They're getting their mojo back. And then, of course, the big investments around, our process technology leading to the foundry business, a whole new area that is so aligned with the Western interest of a balanced, resilient supply chain. Our margins, we laid out a picture for that improving as we go through the year, as we go through the reserves in the front end of the year, as we start, building back and having fully loaded factories, improving the margin structure of the company for the long term. Clearly we've laid out a multi-year path for that to accomplish. We got a lot of work to do, but Q1, meet, beat, and raise was a great foundation to build on for the rest of the year.
All right, we'll leave it there. Intel CEO Pat Gelsinger, always great to get some time with you. We'll talk to you soon. And we'll be right back.
The sudden collapse of Silicon Valley Bank in March led to the government's swift and speedy action to prevent a disastrous contagion. The Federal Reserve now publishing its internal review of its supervision of SVB, all while First Republic Bank is reportedly most likely headed for Federal Deposit Insurance Corp receivership. This according to CNBC's David Faber. Joining us now to discuss the banking sector stresses is former FDIC Chair Bill Isaac. Thank you for joining us this morning, Bill. I mean, when we look at the predicament that, especially now, First Republic is in, I mean, what would a rescue look like at this point?
Well, it's too early to say exactly what they're going to do. They really have two choices. One is to find investors or other banks, perhaps, to invest in First Republic and take over the control of it and the management of it. That's possible, and they're going to have to put some money in, and that's probably the hardest part, is for a private sector firm to put money into a bank who's in the shape that this one is in. The other opportunity is for the government to step in and take over. And if I were betting, I'd say that's probably the direction this will go, but you don't know until they actually get it done.
And obviously, we have this heightened awareness about the bank closures, especially, in light of what we saw with social media going back and forth when everything first started to go down. I do want to draw your attention, though, to IBM's Vice Chairman Gary Cohn, because he weighed in with some context on the bank closures. So I'll have you take a listen, and then I'll get your reaction.
Every year, we lose banks out of the U.S. banking system. So, since Dodd-Frank, I think since the Dodd-Frank legislation after 2008, we've lost over 10% in the banks of the United States. So we've had this slow grinding, whittling away of banks in the United States. I think we're more acutely aware of what's going on now because we've seen larger banks, much larger banks, run into financial trouble, and we've seen larger banks go out of business. I don't think we have seen the end of this banking situation. I won't call it a crisis because I don't feel like we're in a crisis.
And so then, is this a situation where perhaps if we weren't so hyper aware of it, that we perhaps shouldn't be as concerned about First Republic?
I think that's reasonable, not to be over concerned about what's going on. We've actually been in a consolidation in the banking industry for the past 50 years. When I was chairman of the FDIC in the late 70s and 1980s, we had 13,000 banks at the beginning of that period. At the end of that period, we had lost 5,000 of those banks. So I think that's what happens when you go from a highly regulated industry, highly protected. The banks had their own market. Nobody else could be in it. Interest rates were controlled tightly on deposits and on loans. So you had a highly regulated, protected industry, and we have moved into a more open market industry, one that has lots of competition and competitors, more than just banks, but non-bank financial firms. So I think that there's a fallout. There's a consolidation of the industry that's to be expected. The important thing is to make sure that it happens in a way that protects the interests of the banking public, and I think we've done that so far pretty well.
And most analysts agree. Look, obviously SVB did need to be rescued in terms of contagion, but I know you take issue with how they went about it. And we just had a graphic up there about some of the FDIC reforms that you would like to see, including stop bailing out all depositors when a bank fails, improving and better targeting of deposit insurance coverage for these larger depositors, cover 100% of all non-interest-bearing checking accounts held at these failed banks, clear some of these unnecessary operational inefficiencies at the top of the FDIC. And you say if they do all that, then Congress would not need to have the President and the Secretary of the Treasury then authorize the FDIC and the Fed to have these bailouts. If there was one priority which you think should perhaps lead the way here with the reforms, what would it be?
I have trouble coming down to one because that's a package that I presented that I think fits together nicely. And obviously, we need to have more depositor discipline from the largest depositors, and we also need to protect those largest depositors so that they don't lose all their funds, because when they lose all their funds, you impact the entire community around the bank. So I tried to put together a proposal there that is a good compromise. It provides some discipline for the largest depositors, but yet it keeps funds in the community so that the community doesn't suffer unnecessarily, and employers don't suffer, and their employees don't suffer, because we protect the demand deposits of banks, the funds that are there to make payroll payments and keep the community going. So I think that if we doctor this and protect this deposit insurance system in an appropriate way, we can go through these bank failures with a lot less trauma, lot less drama and trauma.
So then, we're looking at still First Republic, their shares were halted at one point today, continuing to sell off though. But at what point should the Fed and should regulators say, look, this bank should be allowed to fail? Because obviously they're thinking of systemic risk, moral hazard, all these different thresholds. At what point do you say enough is enough and really let a bank fail?
Well, I think we should be doing that more often. But when we do, that's why I've suggested changes in the way the deposit insurance system operates, because if we do let those banks fail, we do need to protect the people that need to be protected when that bank fails. For example, we protect all depositors that are under $250,000 because we feel that the smaller depositors don't have the means to really examine a bank and be careful about where they're putting their bank and so forth. Where the larger depositors, they can make those judgments. But even on the largest ones, we shouldn't take all of the money out of the system. We should leave most of it there. I suggested that we pay 80% of the largest depositors, 80% of their money immediately. It comes from the Fed immediately. And then the FDIC will reimburse the Federal Reserve. And then as we collect the assets of that bank, of the failed bank, and we recover some of that 20% that the depositors did not get, then we give them that money as well. So they may wind up losing nothing. They might have to wait for a while. So it's things like that, and covering payroll accounts so that innocent people who weren't even depositors in the bank are able to get their payroll checks and not have them taken from them. If we do things like that, then a bank failure is not the end of the world. It's a relatively minor disruption, and it clears out banks that don't belong in the system. And I think that if we do something like that, we'll have a much better banking system, in my judgment.
We'll certainly see how this plays out and hopefully see some of those reforms tighten up the system as well. Bill Isaac, thank you so much for joining me this morning. Have a great weekend.
Thank you. Thank you.
All right, coming up, Goldman Sachs is doubling down on its commitment to diverse hiring through its Market Madness program at historically black colleges and universities. We'll speak to the program's co-creator after the break. Stay tuned. Supreme Court Justice Clarence Thomas has accepted numerous lavish gifts, including a $500,000 yacht, cruises, and private jet flights, according to a recent ProPublica expose. His failure to report these gifts now highlighting a, quote, double standard for ethics in government. Yahoo Finance's senior columnist Rick Newman has the latest. Hey, Rick.
Hey, Rochelle. I was curious. The Supreme Court does not have what you could really call a code of ethics or a code of conduct. They say, well, when we try to figure out what is ethical behavior, we consult other judges, we consult among ourselves, we look at past legal filings and things like that. But if you want to look up the Supreme Court's code of ethics, you can't find it because there is no such thing. This actually stands in contrast to just about every other organization in the United States, whether it's business or government. Almost every large company has an ethics policy. There's a detailed ethics policy for the executive branch of government, hundreds of pages long. The House and Senate both have a detailed ethics policy. These ethics policies are not perfect. I mean, people obviously misbehave all the time, but at least there is a policy in place. So this is really heating up as an issue with some members of Congress saying, hey, Supreme Court, you guys need to join the 21st century and adopt your own ethics policy. It could be one that's very similar to what to the ethics policy in Congress. And the court so far said, nope, we rule ourselves. So the Supreme Court at the moment is sort of singularly answerable to nobody.
And you figure when you have a lifetime appointment, that makes it particularly glaring, you would think. Also following a story on Bloomberg reporting that South Carolina Senator Tim Scott will make a bid for the White House. So how strong of a challenger is he to Donald Trump and some of these other frontrunners?
He's a sleeper for now, that's for sure. And we're also, there's another candidate, Asa Hutchinson, who is the governor of Arkansas, or the former governor of Arkansas. Both, well known in political circles, but clearly not nearly as prominent as Donald Trump, who is the front runner, according to polls. And also Ron DeSantis would be the next guy in line, although Trump is way out ahead of him in polls. However, I don't just blindly accept this idea that Trump is going to be the nominee. He's facing so many legal problems, and they're really just getting started. There are at least 4 investigations, criminal investigations into him. Then there are civil lawsuits that are very prominent, including this one involving rape allegations that's going on this week. Trump is just going to be completely consumed with legal problems, including active cases for the next 18 months leading up to Election Day 2024. Republican voters still seem to think he's their guy, which is mind-boggling, honestly. But Trump is going to have a lot going on. So it's possible that one of these sleeper candidates could develop some momentum and possibly squeak through. Not likely, but possible.
Certainly going to be a long political season going into 2024. Thank you, as always, our very own Rick Newman. Have a great weekend, my friend. All right, looking to the future now, Goldman Sachs kicked off the week with its 3rd annual Market Madness final competition. Students from several historically black colleges and universities competed in case studies for the grand prize of up to $1 million in grants. That's part of Goldman Sachs' HBCU Possibilities program, which is a component of the bank's $25 million 5-year commitment to HBCUs. Goldman is looking to double campus analyst hiring by 2025. Joining us now to discuss is Megan Hogan, Goldman Sachs' Chief Diversity Officer and Global Talent Head. Great to have you on the show here. Now, in terms of the winners here, I saw Spelman came in first place. My alum, Howard, didn't have the best showing. They won last year. But talk about this competition and really what Goldman is trying to achieve with its pipeline to some of this talent.
Well, the students still did you incredibly proud. They won $250,000, Howard students, for their university. And so I think this competition is really bringing the best of Goldman Sachs. So marrying our intellectual capital with our financial capital to really make impact. And so we started this program in 2021, really as an endeavor to build off of our longstanding relationships with HBCUs. Goldman, for the last 20 years, has had boots on the ground hitting HBCUs across the country. And now we really wanted to take it to the next level, which is how could we incorporate making sure that we were building relationships with students building a pipeline of diversity to Goldman Sachs, and really being thoughtful about paying it forward to the next generation of talent. Hence a $25 million commitment over 5 years, and students getting to know Goldman Sachs professionals through a 4-month immersive program with coaching, building of financial fundamentals, and the opportunity to have the experience of coming to Goldman Sachs to compete.
So for Spellman, who came in first place, how did they edge out the competition? What really stood out to you?
Well, what was fantastic about all of the students is that there were 150 from 12 participating HBCUs who had been working in collaboration with Goldman Sachs coaches for about 4 months. And I have to say, even though 5 groups made it to the final competition, all of the students were fantastic. The best part of this was that we did have L'Oreal as a client who partnered with us on the case study competition. And they really got to learn about the business of L'Oreal and to think about strategic acquisitions for the company. What I think really put Spellman over the edge, by the way, they were our first-year winner as well, is that there were dynamic students who really brought together all of the strategic solutions into one amazing presentation. They had production value, they had pizzazz, and I have to say, as an all-women's group, they really led the pack in understanding what sustainability in the beauty industry could look like and the way forward.
And so with that pipeline into Goldman then, what can newcomers to Goldman expect within the investment bank? Obviously, what we have thought of Goldman Sachs, a lot of investment banking, super high pressure, working crazy hours. What is it like now at Goldman Sachs?
Yeah, what I think it's great. I've been at the firm for about 10 years now, and we are really demystifying what it means to work for the company, who shows up as part of our intern, new analysts, and experienced hire professional populations. And this is the best way to do it, right? Is to have people come directly to our campus to see the diversity of our leadership, to see the impact that we're making, not just on diversity, equity, and inclusion within the 4 walls of Goldman Sachs, but communities at large. And so while this program is near and dear to my heart, we have many that we're very focused on. Our 10,000 Small Business Program, our 10,000 Women Program, and importantly, thinking about strategic objectives that relate to the diversity of our clients. We know that diversity, equity, and inclusion is an important pillar of our firm-wide strategy, but we know that it's increasingly a focus for our clients, for governments, for regulators, because we know that when we build diversity and community, we impact better results. And that's what it's all about, is making sure that we're providing the best profitability for our clients and our communities. And what I think has been really fantastic as well about this demystification is students show up and they say, there are lots of people that look like me. There are lots of people that come from my hometowns and communities. There are more HBCU professionals here than I would have ever imagined. And so it's important that we're not just talking the talk, but walking the walk too, on building the experience of people to see what we can bring to the firm and what we can bring to the communities that we serve.
And just very quickly, what's next then as Goldman, continues with this? This is a 5-year commitment here, but what happens next?
So after the program ends, we will be very focused on making sure that we build that pipeline, not just into our summer intern population, but new analysts as well. And so what's been fantastic is that 25 students from the first 2 years of the program are starting with us this summer as summer interns and new analysts. And so we're just building the base of the pyramid. We're getting more and more students from HBCUs. We're going to meet our commitment to double new analyst hiring by 2025. And those students are going to become not just new analysts, but associates, vice presidents, managing directors, and partners here at Goldman Sachs. And so what's next is simple. It's about retaining the best and brightest of HBCU talent to make sure that we see them in the senior leadership ranks all across the firm.
We love the work you're doing. A big thank you there, Megan Hogan, Goldman Sachs Chief Diversity Officer and Global Head of Talent. Thank you for joining us on Yahoo Finance.
Thanks so much for having me.
Right, shifting gears now, Tesla was a pioneer in the electric vehicle space as the EV boom fueled the company's growth. And with the hunger for EVs came the spread of electrification, now finding its way into the motorcycle arena. So who will bring the Tesla of motorcycles into this two-wheel race? This next company says it has exactly that. Joining us is Matt Chambers, CEO of Curtis Motorcycle Company. Thank you for joining us this morning. So when people think the Tesla of something, people have some different feelings about Tesla. Obviously, a very innovative company, have a very charismatic leader as well. Where do the comparisons between what you're doing with electrification of motorcycles and Tesla, where do they begin and end?
Well, we are honored at Curtis to be on your show. The situations, we're in a very small market like they began in. And only 63 motorcycles were delivered by Harley, which would essentially be, I presume, the biggest one today. So we'll start this year with 30 bikes, starting at the very top, like Mr. Tesla did, rather. Our bikes are very expensive, like his initial Roadster was, $120,000 and above. And then we'll work our way down. We've got superior technology. He was the first to use the skateboard architecture and electrification for the automobile. We've just received our patent on what is termed axis-centered design, the first time when a motorcycle actually grows from the inside out. Motorcycles have always been a motorized bicycle, and then in electric, they've taken the petrol-fired motor package out and put in electrification. At Curtis, we start with an axle through the center of the motor, frame the symmetry of the motorcycle first, and create this glorious, beautiful outcome. So we feel like we've got the edge on technology, on form. We have a great brand. We have a small band of enthusiasts, and we have perfect timing because we're coming into a very small market, projected to grow to hundreds of billions of dollars in the near term.
And we know that brand loyalty, very important when it comes to Tesla drivers. It really is a community there. But obviously, it's a high price tag, $120,000, as you mentioned there. But a lot of this it's highly customized work. So who exactly is the demographic that you're looking at?
Well, we hope we can bring a whole new group of people to riding the motorcycle. It's so easy. You don't have to have any particular skill set. If you can ride a bicycle, snow ski, or play tennis, you can ride a Curtis with great aplomb. So it's like flying when you're on it. You glide. It's very, very refined and smooth, and there's no maintenance. Like you have all the maintenance hassle with the petrol-fired machines. So we hope we'll bring in this whole new audience of people that can just go out to their garage and hit a switch and go for a little flight around the neighborhood, come home and feel refreshed. It's really, really wonderful.
Now, of course, you mentioned Harley, and they spun off their their electric motorcycles, Livewire. Would you say they're your biggest competitors in the space at the moment?
I think they would be, but there really is nobody. So kind of when Tesla launched, there was the Leaf and the Bolt, but they were not terribly desirable vehicles. So what Mr. Musk was able to do is create the first electric car that people actually wanted to own. The problem in the EV motorcycle space, a space that I think electric is better for the motorcycle than for the car because the refinement just is a game changer. In a car, even petrol-fired cars are very refined, but petrol-fired motorcycles are hot and shunty, and they vibrate and they smell and all that stuff. But the bottom line is, our argument, and with axis-centered power, we were able to frame this symmetrical design. And we feel we've really nailed the beauty of the machine. And people want to own a motorcycle because it's beautiful. And taking ICE components out and putting electrification or electric components in actually has not worked terribly well for the aesthetic. And of course, we want the bike to ride like it looks, and we believe that it has beautiful control. The balance is just a little bit better when you ride the Curtis than on any other motorcycle I've ever been on.
Now, I do want to ask you about really the ecosystem that comes around this, because as with EVs, people worry about, my ability to charge it, how quickly can this charge, perhaps even some of these input costs throughout the supply chain. We saw that Tesla was having some issues with its pricing going up and down, sort of based on some of those changes as well. How does your company plan on managing those sort of costs and really the greater adoption when it comes to EVs?
Well, the bike we're starting with, it would be like if you went out to buy a V12 Ferrari Roma it wouldn't matter how far it went, how big the gas tank was, what kind of gas mileage you got. So the wise thing, as Mr. Musk did, in the part of the market we're starting with, this is just a gentle cruise, something you would wake up early Sunday morning, you put your helmet, your beautiful jacket on, and you go down to your favorite little place to have brunch or coffee, and then you just ride it home. So the issue of range for us, the market that we're going for is not relevant. Now, we've already worked out our supply chain. We have 130 rounds of parts. We're going to build 30, 40, and 60 over the first 3 years, thinking very small. But then after that, it's sky's the limit, just like our original founder who started in motorcycles and then invented naval aviation.
I mean, you had me at riding to brunch. I wouldn't mind checking one of these out. A big thank you for joining us this morning. Matt Chambers, CEO of Curtis Motorcycle Company. Gorgeous bikes there. Thank you so much.
Thank you so much.
Right,
we
well,
appreciate
before we
it.
go, you're very welcome. Before we go, let's get you a quick check of the markets. We see that all three have turned positive. We started out the hour with a mixed picture here. We see there the Dow picking up speed there, now up about almost 200 points on the day. The S&P also seeing gains of 0.5%. Tech-heavy Nasdaq also turning positive despite some of those pressures from AWS weighing on the tech industry earlier this morning. And we're also taking a look at some of the sector action as well, because at first we were seeing communications and consumer staples really being weighed on as we got some of this information on core PCE, a key gauge for the Federal Reserve, coming in a little bit hotter than expected year over year. We are still seeing that consumer discretionary still the biggest drag on the S&P in terms of sectors as we head into this noon hour. Well, that'll do it for today. I'm Rochelle Akufo. I will see you Monday at 11 Eastern. Until then, have a great weekend, everyone.